You having a drink?
I did that for you.
Having a longer drink? You got something to say?
No, I'll get to the longer drink in a moment. What's transitory, John, is Gareth started yesterday.
Gareth started.
Gareth started.
Serious
Did the Tots win?
The Tots came back and
There we go.
won to save.
Is that why you're in such a good mood this morning?
I'm in a good mood. You know, it's fascinating here, John. We don't have time right now for this, but I'm fascinated how J.P. Morgan comes out of this soccer debacle.
Yeah, many people are, Tom. Many people are.
Amazing.
Yeah, I agree with you. Coming up in the next hour, Tony Dwyer, Canaccord Genuity Chief Market Strategist. Equities bounced back yesterday.
Please.
Equities down 3, off by 0.1%. TK, just for you, so you can have another drink.
Just drink anyway.
Transitory.
Thank you.
This is Bloomberg.
With the first word news, I'm Rishika Gupta. President Biden will pledge to cut U.S. greenhouse gas emissions in half by 2030. That nearly doubles a commitment made under former President Obama that was later scrapped by former President Trump. President Biden will convene 40 world leaders in a virtual climate summit that begins today.
Okay, guys, like I said, we just restarted our channel. Order place to buy Bitcoin for all new guys, so stay with me, and when this order will be filled, we will go through this trade. At this moment it's not filled yet, so probably it will take a while, maybe a couple of hours, maybe half an hour. Bitcoin, they stay really volatile, so you never know, but I already placed an order, so if you want to do it right now. I'll speak to you later. Stay safe.
Credit Suisse. Joe Biden is set to become the first U.S. president in 40 years to recognize the mass killings of Armenians as genocide. That runs the risk of upsetting an already fragile relationship with Turkey. Bloomberg's learned that the president's pronouncement will likely coincide with Saturday's Armenian Genocide Day. The killings took place under the Ottoman Empire, which later became Turkey and various successor states. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishika Gupta. This is Bloomberg.
valuations, particularly, sort of the technology landscape, have gotten to some pretty extraordinary levels. So I think it's not a surprise. I don't think it's any indication of the beginning of the end, but I do think markets don't like uncertainty.
This is fundamentally an issue, becoming an issue of competitiveness, of economic competitiveness. The firms that are innovating, that are lower carbon, that are part of the solution, and the financial institutions that are getting behind those solutions are doing very well. They will do much, much better. This is where the world's headed. The question is pace.
Really great to catch up with Mark Carney, the former Bank of England governor and UN Special Envoy for Climate Action and Finance. From New York City this morning, good morning. Alongside Tom Keane, Lisa Abramowitz, I'm Jonathan Ferro. This Thursday morning, an ECB rate decision just around a corner, a news conference with Christine Lagarde as well, and claims in America. Going into that, equity futures shaping up as follows on the S&P 500. Slightly negative on the S&P. We're down 3 and off by 0.1%. In the bond market, yields higher by almost a basis point to 156.27. Euro dollar maintaining that 120 handle at 120.54. Credit Suisse in Zurich, Switzerland, down by more than 6%, off by 6.29% as they come out. Look at another 600 million hit off the back of the Archegos chaos and have to raise 2 billion on top of that. Tom, that's the story out of Zurich. Let's talk about the story here in the United States on this Earth Day. Bank of America producing some research early on this morning. It pays to be green. We see higher multiples for low emissions, net zero targets, and water efficiency as well. Investors are on top of this in a much bigger way in the last couple of years.
A little perspective, John. I unfortunately remember the first Earth Day. I was a senior in high school. Good morning, all, in Fairport, New York. And it was a joke. The first Earth Day was like, really? You've got to be kidding me. Except the air pollution of this nation, John, is dramatically better than it ever was. I, like so many, use Los Angeles as the litmus paper. I remember unable to see the San Gabriel Mountains, unable to breathe in Altadena and Pasadena a million years ago. And it is better right now. Jack Fitzpatrick knows that as well, running our government reporting in Washington. Jack Fitzpatrick, good morning to you. Can the president legislate climate change? Is this a PR or an executive or a get reelected or make the international community happy exercise? Or can we actually legislate climate change in your Washington?
Legislating climate change is the hardest part of addressing climate change, but based on what we've seen from Biden so far, it does look like he's going to put in a lot of effort into legislating it rather than doing things entirely on his own. If you look at what he proposed in the infrastructure plan in terms of things like electrifying the federal fleet, electric car infrastructure, but also about $400 billion in tax incentives for clean energy, that's a lot different than what Obama did, relying very heavily on the Clean Power Plan and things that the executive branch tried to do on its own. That doesn't mean he won't go on his own, and it doesn't mean he's necessarily destined for success working with Congress, but he is trying to legislate a lot more on this than we've seen from past administrations.
Jack, I'll choose my words really carefully because corporations are doing their own thing. Cities are doing their own thing. Is the federal government the place where we have an issue in this country right now? Is that where we have a credibility problem?
Yes, if you talk to climate activists, even just Democrats who want something to happen on climate change, there's been a lot of action from cities. There's been a lot of action in the private sector, but the federal government has been the one that's really, really slow to move in its part on the big, broad parts of this, the regulatory side of the electric sector and the infrastructure side on the transportation sector. And you can see why politically it's been slow to happen. But if it's tied into an infrastructure package that could be bipartisan, maybe there's movement there. But yes, the federal government has been really slow on this.
Well, let's talk about what's top of the pile in this press release from the administration this morning, Jack. Good paying union jobs, U.S. leadership. Buy America is also in this press release too, Jack. How important are those issues at the moment?
those are exactly how the Biden administration is going to frame this. I mean, they have TV ads talking about getting America to work on these climate proposals. And there is a lot of spending. There is a lot of infrastructure related focus on what they've laid out for their climate plans. The issue for them is that could be separated from whatever they want to pass. Republicans are saying, why don't we do an infrastructure package, roads and bridges, but take out all of this climate related stuff. We can pay for it with user fees. The message doesn't necessarily sell itself, and that is exactly where the pushback is coming from Republicans in Washington.
And there's also a conflict between how the current administration sells a climate plan to Republicans, to a bipartisan committee of Congress members, versus to the world. And this is sort of the conundrum. I mean, if you have sort of an America first, this is going to bring jobs back here kind of approach, how can the U.S. lead globally and say that this is good for everybody?
Well, in that sense, it may not, the way they sell it publicly and the way they sell it to Republicans may not necessarily be different. The spending and building infrastructure approach, as I said, is a more bipartisan approach than focusing really heavily on regulatory aspects in the electric sector. You can build and create jobs, but you can also sort of use the stick rather than the carrot. The Biden administration is focusing on a combination of both. The question is, can they sell it to Republicans? And in some cases, they seem to have had some positive talks on how to pay for electric car infrastructure, the charging stations, that kind of thing. Yeah. But it is still a challenge, clearly.
Jack, it's great to catch up, sir, and good to see you. Important day. Jack Fitzpatrick there, Bloomberg government reporter. Lisa, I think you took us to the right topic. It's how this is sold abroad, if this is going to be sold domestically as a domestic issue, a Buy America, Hire America issue. Think about who's at this summit today. Xi, Putin, Bolsonaro, Biden as well. They've all got to agree on something like this. That's going to be tough.
Good luck, right? I mean, you think it's hard getting Congress together in Washington, D.C., try to get this crew together and agree on some sort of climate proposal. The issue here, too, is that the economy globally is struggling. The U.S. is actually better than the vast majority. So, these countries have to think about how they could shore up their own economies. How does the Biden administration say it's good for them, too, even though it disproportionately benefits the U.S. with job creation?
Internationally, Tom, the stage is pretty fraught right now. And I think there were some people out there in the last couple of months suggesting that perhaps countries like China, the Chinese Communist Party, would use this as a bargaining chip to get this administration to back off on other issues.
There's no question the other issues matter, including the unraveling pandemic. Just in the last 72 hours, John, the pandemic
India
is terrible.
Tom.
What I would go back to is a re-listen of Mark Carney yesterday. He was on fire about how this is not going to be solved at the federal level. It's going to start at the local and at the business level, and that will continue to drive forward the debate.
Couldn't agree more, which is why I framed the question the way I did, Tom. This is a federal government that has the credibility issue, not cities, not corporations. Companies, Tom, are well ahead of this already, and they have been for the last several years.
Well, yeah, they're well ahead of it. We go back to the Paris Accord, and what we'll see out of that as well, full disclosure, Bloomberg Philanthropies, folks, has been a huge supporter of that. But, John, I would go back to the immediacy of President Biden, and how does he address this today, particularly with Xi of China?
He will speak a little bit later this morning. Coming up, Frances Donald, Manulife Investment Management Global Chief Economist. We'll talk to her about the economy and this market. Equity futures, 4160, down 4, a negative 0.1%. This is Bloomberg Surveillance.
Asia is absolutely core to our business. It's almost 20% of our franchise revenues globally, which is significantly more than most of our global peers who are more in the mid-teens.
We want to invest, grow in China, but also we are also investing in the rest of Asia as well. Our top line growth for the region has been close to 24% last year, almost 20% of the group's revenue as a percentage of the revenue of the group. So, and this is where the group is counting on the growth.
We see company after company, these are corporates committing to net zero. So pretty much across the board, there is an enthusiasm for putting capital to work to try to get us to a better carbon future.
Credit Suisse has a fantastic brand name in Asia. We have obviously strong positions in Singapore and Hong Kong as our two main hubs, but across the region.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
From New York City for our audience worldwide, live on Bloomberg Television, here is the price action this Thursday morning. Equity futures down around about 4 on the S&P 500, slightly negative by about 0.1%. The Russell off by 1/3. This after a nice ramp into the close in yesterday's session. We pulled back just a little bit, going into claims a little bit later this morning, looking for something a little north of 600,000. Hopefully, we get something better than that. If you switch up the board and get to the bond market, 2s, 10s, 30s, what am I looking domestically in the United States? What am I looking at? I'm looking at vaccinations. And the rate of vaccinations in this country start to roll over a little bit, just start to slow down. We'll touch on that a little bit more, a little bit later in the program. Yields this morning higher by about a basis point on a 10-year to about 156.44, call it 226 on 30s. The first quarter was America's quarter. That's the line from Deutsche Bank and George Saravelos on Bloomberg Surveillance, the early edition with Francine Lacqua a little bit earlier this morning. His call is Q2 will be Europe's quarter. So switch up the board and get to euro dollar. He's looking for a move towards 125. Right now, 120.51. Your euro just slightly weaker year to date by a little more than 1%, but it's the inflection, Tom, over the last week or so, last couple of weeks, as we reclaim a 120 handle off the back of better than expected vaccination progress. We're seeing it in Europe, maybe a little bit convergence between Europe and the United States. Tom, unfortunately, we are not seeing that in Brazil, and we are certainly not seeing that in India right now either.
Well, we are, and I'm glad you bring it up, and I'm glad you bring up George Saravelos as well, as there are a lot of different moving parts. We're going to try and coalesce them now into a really, really important conversation on the American labor economy. Francis Donald, you are expert at this. Thank you for joining from Manulife this morning, and I want to really dovetail George Saravelos' note early this morning. Saravelos is in foreign exchange. He's looking at strong Canadian dollar. Francis, you live and breathe this with Manulife of Montreal, so we've got a wonderful nexus here of George Saravelos and Francis Donald on the Canadian-U.S. difference. And the answer, Francis, according to George, is Canada's creating jobs, and Chrystia Freeland and Trudeau have a nation getting back to real labor excellence faster than America. How long is it going to take for America to stop replacing restaurant jobs and get back to actual true job formation?
There's about 6 questions in that, Tom.
I tried. I was going for 7. I failed.
Let's start with what we can learn from Canada. Canada is telling us a couple really important stories. One is that relative fiscal policy is a key global market driver. That's true between Canada and the U.S., but also the U.S. and Europe. The second is that labor market healing is going to be a key component to our 2021 and 2022 forecasts. And places like Canada and Europe did not experience the same drop in labor force participation rates. What matters for the United States now, for me, the most important known unknown is how fast labor supply comes back to America, because that's the key to wages. That's the key to unlocking 2022 and 2023 growth. Now, last but not least, when we look at these two economies, we do see an important story, which is the U.S. really Q1 story. I love that. A lot of very good news priced into the U.S. story. I talk about peak reopening in the U.S., peak reflation in the U.S. Where are expectations really low? Where are the hawkish surprises? Where are the upside surprises outside the U.S. in places like Europe and Canada? My view is the next big move higher in U.S. Treasury yields is not going to be U.S. driven. It's going to be globally driven, probably Europe.
Okay, but Francis, let's go all Marshallian here, folks. This is Alfred Marshall, supply and demand. You know, the little XEX thing that Francis is expert at. Is this about labor supply coming on, or is it about labor demand in America?
It's going to be both. And this is one of the biggest challenges, is that we have this whole list of missing inputs into our outlook. And they range from things like, what are corporate taxes going to be? What does the infrastructure plan look like? What about the double mutant variant? Apparently we have to incorporate this now into our outlook. We do not know how fast labor is going to come back, demand or supply, because we've never lived this before. So you hear high conviction economists and strategists who say we're fully healed, we're back to full-time employment or full employment by 2022. We just don't know. We don't have the example. And critically, on top of this, the Federal Reserve has told us they're not just looking for full employment by our traditional metrics, but a broad-based and inclusive employment goal. So even though we're still running, we're trying to figure out what we're doing, the goalposts are also moving at the same time. It makes for a complicated forecast, and I really think we need to be thinking about wide confidence intervals as we go through the next few months.
Yeah, John, I like that word complicated, and that it's a nation moving in fits and starts.
It's a complicated issue for the airlines too. And talking of fits and starts, domestically, things have really picked up in America for travel. Internationally, not the story. So here's an airline with a domestic tilt. Southwest coming out and saying they're hopeful to achieve break-even by June. The first quarter adjusted loss coming in at around about 172. The estimated loss, 185. 172 the number, the estimate 185. Hopeful to achieve break-even by June. Lisa, here's an airline with a domestic tilt. A little bit later this morning, I believe we get an American Airlines earnings as well. There's an airline with an international tilt.
Yeah, and when you look at the overall picture, IATA, the International Association for Airlines, came out yesterday and actually said that the net loss would be substantially bigger, $10 billion bigger this year than they had previously expected, John, because of the variants, because of the prolonged nature of this pandemic, which just isn't exactly going away.
I want to use that term that Tom used, fits and starts. Francis, this will come in waves. The reopening won't happen all at once. What does that mean for you, just as a market participant as well?
Well, the complicated element of this is when you're an economist sitting in an investment team, you have to say what's going to happen to the economy, and then importantly, how much of that is already priced. A lot of good news in this price right now. So when I hear headlines like IATA saying, actually, we're going to be a little bit less than expected, this is what worries me. The scope for downside surprises in the United States is bigger. But more problematically, I hear a lot of people saying, you know, I'm very bullish the economy because I got on a flight to Florida and it was packed. The question for you is it still going to be packed in 2022 and 2023? You're going to notice a lot of economists are talking now about boom busts, the short cycle. A lot of forecasts are showing a sizable drop in growth for 2023. Now, that might seem very far off, but that's your fiscal impulse coming off. So fits and starts over the next 3 to 6 months, absolutely. We're going to have to trade those. It's going to be a very tactical, range-bound market. But where my eye is the strategic fits and starts, which is, do we see in the United States a pull forward of demand that's very aggressive for 1 to 2 years? And then are we facing a little bit more of a problem in the back half of these 5-year forecast periods?
So you wear two hats. So let me just address that question a little bit more specifically. When you say the scope for downside surprise, more scope for downside surprises in America, as an economist or as a market participant?
Oh, as both. The problem, however, is that we're looking at a market, and even though I can say we've seen peak reflation, peak reopening in the United States, I cannot be short equities in this market. I absolutely, don't want to be long bonds, particularly after this move, even if there's a little bit more upside. Rates are still incredibly low. If you want to make your return profile, you have to be allocating to equities, particularly with momentum still in your favor and the low rate environment. So now is the time with your sector rotations to be adding internationally, to be focusing on country risk and country plays. That's the way we're going to make money in the next 6 months, as opposed to trying to make these calls on broad risk or headline SPX.
Meanwhile, Francis, this is Earth Day, and I'm wondering how much you're paying attention to some of these proposals from an investment perspective, especially as President Biden puts money behind it.
Absolutely every single day. I'm often asked, what's the biggest delta on your forecast, biggest change on your forecast, the transition from the Trump administration to the Biden administration? It's actually green spending. Now, importantly, when we talk about fiscal spending, people usually say this amount, billions of dollars or trillions of dollars equals this amount of growth. But how it's spent is what determines the fiscal multipliers. Green spending is going to have a longer horizon with a different fiscal multiplier. The other component of that that's really critical is we watch green bond issuance as another big component of future asset allocation. A lot of thirst for that. So incorporating ESG investing, looking at green spending, key component of the economic outlook, but also the investment portfolio construction.
Francis, I want to dovetail this idea of a green initiative with where we began this conversation, and that is jobs and wages. And we have Biden coming out and saying that this will actually generate well-paying jobs, but you've got union groups pushing back and saying that solar and wind companies have been really opposed unionization and opposed efforts to try to bring wages up in that way. What's the truth?
The complicated element of this is all forms of infrastructure spending, from green to highways. The IMF has plenty of work on this. They hit the economy with a long lag. So you can announce these sorts of initiatives, but we don't see them traditionally from anywhere from 3 to 8 years. So finding that truth and what happens in reality is not going to happen next year. The market's going to have to be patient on seeing that. And this is why I say heading into end 2022, 2023, there's going to be a pothole in the economy. I think the market is starting to sniff that out.
Knowing what you own is so difficult right now, Francis. We hear that term greenwashing. BlackRock put out a transition ETF recently, huge demand for it, loads of inflows, as you might expect. Then you go through the top holdings of this thing: Apple, Microsoft, Amazon, Alphabet, and Facebook. Now, maybe they are the leading companies making a transition in the United States of America. Maybe that's the right way to benchmark this ETF. But for the people who are allocating capital to some of these stories, Francis, do you think they really know what they own right now?
Well, my focus on this is actually moving away from company-specific risk, also because I'm a macro strategist, so it's not my area to the same extent, but focusing on country risk on this component and the ESG country screens that are coming through. Sitting up here in Canada, as Tom unveiled to everybody, of course, we're talking about having to do early and cheaper green transitions or fearing access to global capital markets. And I think countries as a whole are going to be accelerating green spending in order to avoid losing capital flows. And that's the component of the macro story that has to integrate the green infrastructure component, or you're going to get the trade wrong.
Francis, really, really interesting final point. Great to catch up, as always. Francis Donald of Manulife. Always great to have Francis with us, Lisa. Often putting Tom in his place as well.
Yeah.
At the very beginning of every single conversation.
There are about 6 questions in there. Want to throw a seventh in there? I love
often
it.
6 questions in there.
We do panels together, and she just crushes me on stage.
I have no doubt about that, Tom. I want to turn back to these Southwest Airline headlines. Aiming for break-even by June. Here's a domestic company, a domestic tilt to this airline. American Airlines a little bit later this morning. I wonder how different those headlines will be for an international airline like American, Tom.
Yeah, well, there it is. And, you know, you wonder what the airlines are going to do domestically. International, John, I think is out of the picture. To your ESG focus, John, I think the last 24 hours on JP Morgan, my PR firm, Hartley, mentioned this yesterday. What does JP Morgan do out of this with their European soccer greed? I can't figure out if they're tarred and feathered by this, John. To me, maybe they're not. Am I right?
I don't know. I just think there's so many different stakeholders in all of this just sort of miscalculated how this would play out. And not just the banks and maybe the accountants and the advisors that got involved in all of this, Tom, but also the leaders. You know, we touched on this earlier this week. This wasn't just about foreigners owning British companies, English football teams. This was about the likes of Florentino Perez, the Agnelli family. And I know I've been saying that all week, but I think it's easy to overlook that fact. These are individuals with great experience that have been around the sport for a long, long time that made the mother of all miscalculations. Nothing to say? Okay.
No, I was just thinking about Padres Dodgers.
Unreal.
I got Padres Dodgers.
Seriously.
I think you need a mute button.
Okay, coming up, Dr. Jennifer Nuzzo of Johns Hopkins. This is Bloomberg.
With the First Word News, I'm Ritika Gupta. Credit Suisse is raising about $2 billion to shore up capital. That's after warning of another financial hit from the Archegos capital collapse. $654 million in the second quarter. Here's Credit Suisse CEO Thomas Gottstein.
Archegos was a situation that is now being reviewed also by U.S. regulators. It was a very idiosyncratic situation with a family office which had some deficiencies in terms of disclosure. And, you know, there were 6 or 7 other brokers involved in that. So it was certainly not only a Credit Suisse issue, but we certainly had higher exposures than others.
Meanwhile, the Swiss regulator FINMA has now started enforcement proceedings against Credit Suisse. Bloomberg's learned that the Biden administration will restore California's power to limit auto emissions. That's a shift that will lead to tougher requirements across much of the U.S. Two Trump-era policies limited California's ability to set ambitious vehicle standards. Global News 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Minority myth wasn't something that was fabricated by the Asian Americans. It was created as a tool to alienate the Black and the Asian American communities, and it was incredibly successful.
We know the racism didn't begin yesterday. We know it's probably not going to end tomorrow, but it is our job to make sure that there's progress and we keep people safe, give people dignity.
I spent a lot of time last year to just listen, to understand, to reflect and understand what I could do as a leader of this organization.
For many years, we've been very shareholder focused, and now there really is much more of a community requirement.
The economic downturn in the U.S., we're seeing unemployment and income losses affecting women more than men.
2/3 of the jobs lost in South Africa were women's jobs. So I think we're in a moment of crisis.
Clearly, our societies are reproducing, not producing inequality.
We need better public policy and we need companies to step up.
We're early on in this year. I know we've already sort of penciled in 6 or 7% growth and a big fall in unemployment, but under outcome-based policy, we really want to see that.
I'm bullish on the rebound, but I know we have a long way to go before the job is complete.
There's no textbook for this. You don't want to be too preemptive, but I also don't want to be so reactive that we're late.
I think it's too early to talk about changing monetary policy while we're still in the pandemic tunnel.
That over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
Looking at
what is going to be done with some of the vaccines that we are not using. We got to make sure they are safe to be sent, and we hope to be able to be of some help and value to countries around the world.
That was President Biden on a really important issue. The pace of vaccinations in the United States of America is starting to slow. Supply is not an issue. The pressure is growing to start issuing some of that supply worldwide to where it's needed most. And I think a lot of people right now are thinking of one place, and that's India. From New York City this morning, good morning. Alongside Tom Keene, Lisa Abramowitz, I'm Jonathan Ferro. Here's the state of play in this market this Thursday morning. Equities are down 2 points, not even 1/10 of 1%. The story of the bond market, 155.92. Euro dollar 120.50. We advanced there a little more than 1/10 of 1% going into that ECB rate decision later this morning, in about an hour from now, at a news conference 45 minutes after that. There's the headline, Tom, connected to the story out of India. Singapore to bar visitors from India on the deteriorating situation, which is just getting worse and worse.
Just a matter of time until we see that from other geographies. We've seen this with the Philippines, with Brazil as well. We're going to have news on Goldman Sachs here in a moment. Stay with us, Global Wall Street. Right now, Jennifer Nuzzo with us, Johns Hopkins Center for Health Security. And all of a sudden, our international health security is important. Jennifer Nuzzo, how far are we from a humanitarian crisis in India?
Oh, I mean, we're on the brink. The stories that really worry me the most is hearing about shortages of medical oxygen. I mean, to think that, you know, you can save people's lives by supplementing their oxygen and they just don't have it. Oxygen, something that's easy to make, that is really, I think, a severe tragedy.
How close are we to shifting to, say, 1947 and the starvation of Europe, the Netherlands, post-World War II Europe? How close are we to where there will be a call for international developed nation and American responsibility to assist India?
Oh, we are there. If the call hasn't already been sounded, let's sound it now, because there is clearly a deep, deep struggle there, and they need help. And, you know, the United States is not going to be back to normal, fully safe, until we help countries end these very concerning surges of these cases.
Based on the surges that we have seen, how much has the end of the pandemic been pushed out?
Well, I mean, it's really hard to say. I mean, we still have parts of the globe that haven't gone through this yet. And you don't want any country to go through this where you see a massive surge of cases. But any country that has not yet had a surge of cases and is not actively vaccinating its population remains at risk to exactly this scenario. I think earlier there were countries that maybe breathed a sigh of relief that somehow assumed that they escaped the worst of this pandemic. But we're seeing quite clearly that that's very much not the case, that many parts of the world still remain deeply at risk. So I worry about these headlines continuing for a year or more unless international partners get together and help share some of the vaccines that are there. We need to absolutely make more vaccines. There's clearly a shortage of medical supplies that needs to be addressed. So a lot of work that the globe can do to help countries and to, you know, try to lessen some of these hideous tolls that the pandemic's already had.
We need to make more vaccine, and we need to convince people to actually get inoculated. John touched on the fact that there is a slowing pace of vaccinations in the United States. How concerning is that?
It is quite concerning. I just read a study about an outbreak in a nursing home where most of the residents were protected with vaccines, but only about 53% of the healthcare workers in the nursing home here in the U.S. Had been fully vaccinated. And unfortunately, one of the residents who had been vaccinated, and this can happen particularly in medically frail individuals, died. So this is a real problem. And then, of course, we're hearing about states pulling back on ordering vaccine, that they are not having the kind of uptake that they had been having. This is something that I think we have to address with much urgency. I think there are some people who are probably just trying to wait and see. I think there are some people who don't feel that they want to get vaccinated, but we need to reach both of those people, both of those groups of people, and convince them that, you know, your time to get vaccinated is as soon as you're able. And the faster we do this is the faster we get back to normal.
What a tough moment to be a leader of this country right now and make this decision, Doctor, because there is so much pressure to take some of the supply here and allocate it to the rest of the world where it's needed most right now. How do you make a decision like that when some parts of your country have decided they don't want this vaccine?
Sure. Well, it is a tough decision. And, you know, every elected official, their first responsibility is to the people who elected him or her. In this case, though, the United States has more vaccines than we need. Even if every single American were to get a vaccine, we still have more than we need. And so I think it is important for us to consider donating, at least to cover some very high risk groups like healthcare workers that are working across the globe. They show up every day, put their lives on the lines to save people's lives. We should be able to protect them. And the U.S. has enough vaccine to be able to help in those efforts.
Doctor, thank you. We have to leave it there. Dr. Jennifer Nusso there, Johns Hopkins Center for Health Security Senior Scholar. What a delicate moment, Lisa. A decision that is really difficult to make for any leader. Of course, you have to put your own people first. But when you start to see it showing up in the data, the hesitancy in the United States of America, and you see a crisis playing out in Latin America, in India, in Brazil, in places like that, the pressure's going to build on you to do something.
There's the humanitarian aspect of this, the images that are just absolutely horrifying of people struggling to get into the hospital, not enough people, not enough beds, not enough oxygen. But it also is an issue of economic recovery. Can the United States fully recover without the rest of the world on board? The answer is no. We're seeing that already with airlines. Yes, Southwest was okay, but when we see American, it's going to be a different story due to international travel. Can we end the pandemic unless we do some more outreach?
Southwest okay, Alaska okay as well, topping estimates this morning. Once again, an airline with a domestic tilt. TK, I know you wanted to talk about Goldman. Big call this morning.
It's a big call, and this is one of those tea leaves, John, within earnings season of a reset. This is Keith Horowitz, who writes very careful notes. It's Citigroup, and it's not what he says on Goldman. He says, look, this is not an extrapolation of a boom quarter. We all know they had a boom quarter. It's a refresh of his Excel spreadsheet, and it gets him out, John, up 20%, which really gets my attention.
Price target 410. Right now, 335. Off the back of that first quarter, Tom, let's talk about it. Yeah. Execution, wow.
Well, I go back to Brad Hintz at Sanford Bernstein, for Bernstein, who was frankly legendary in this. You don't extrapolate the securities business. It's a good way to lose money. Horowitz is not doing that here. He's not extrapolating out a boom. He's just resetting for their market share dominance and their marginability.
And we've had a boom year to date on this stock. Lisa, up more than 25% and more plus for Goldman stock this year.
Yeah, outperforming a lot of the other banks. I do wonder, just on a more bank perspective, not necessarily Goldman Sachs, how long that can continue unless you see a regaining of the reflation trade, because we have seen a bit of a cooling in the yield curve steepening. And how much does that have to regain for the banks to continue to outperform?
Up 27 on Goldman. That's a headline we're not discussing when it comes to Credit Suisse. Tom, that news this morning, raising another $2 billion, taking another $600 million hit on the quarter, just not pretty.
Again, it is the response. I really, we don't editorialize, but to be kind, it was not American. The lack of urgency, I was floored.
By definition, it wasn't, Tom, so floored. I think you're allowed to say that.
No, we're in control. Business, we're in control. We're in control.
Stock's down 6%. Tony Dwyer up next. Canaccord Genuity
Nothing to see here.
Market strategist. Futures down 5, off by more than 1/10% of the S&P. ECB decision in the next hour. This is Bloomberg.
focus is odor detection. And this is because no matter how you're bound, what container you're in, you're still producing and releasing odors. And we're kind of building off of wildlife detection dogs.
Big tech such as Alibaba and Tencent are no doubt national champions, but now China is stepping up oversight. Just how far will the Chinese government go on regulation? We'll explore on a Bloomberg special, Red Lines, China and Big Tech.
Our generation's biggest problem.
Climate change is happening.
And the world's most innovative solutions.
Transport, industry, buildings, electricity, all of those things.
Everything you need to know about our changing environment, the politics of global warming.
We can and we will deal with climate change.
In the fight against climate change, Bloomberg Green has you covered.
We've just been hugely stress tested here, right, with this bond yield tantrum, and sort of markets sort of survived.
We are looking not just at the peaks, right? We are looking at the sustainability of these trends.
Where policy stance is today needs to be seen through, but absolutely there are some tough decisions ahead.
What the bond market is telling you right now is not so fast. Fed has the upper hand.
We still have the long-term structural forces that weigh against significant acceleration in growth.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
From New York City for our audience worldwide, good morning, good morning. This is Bloomberg Surveillance live on TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Ferro. Equity futures this morning slightly negative. You will hear from the President of the United States on this Earth Day in the next hour. Going into that, we will have an ECB rate decision 45 minutes following that decision. You will hear from President Christine Lagarde. We need to talk about this market and one bank in particular. Credit Suisse down another 6.5% in Zurich trading off the back of raising another $2 million and taking another 600 million hit off the back of this Archegos chaos, Tom.
And John, more importantly than that, the intraday chart on Credit Suisse and Zurich is a fragile down 6%. We haven't broken down to the twice lows of the last 3 or 4 hours, but by no means is it a drop down off the share dilution and then a move up. We haven't seen that yet.
Lisa, raising capital, raising capital, raising capital. The issue for Credit Suisse is we've seen this story so many times now in recent times and over the last 10 years too.
We also don't really understand what exactly happened at Credit Suisse, and it comes at a time when a lot of banks are reassessing how much leverage they're going to extend within their prime brokerage units. I thought, John, really interesting that the SEC is considering forcing more disclosure for hedge funds around their derivatives positions. Of course, hedge funds pushing back and saying that that would tip their hand, and it also would subject them to potentially bad publicity and pushback.
Are we calling this a hedge fund now?
Well, I mean, for all intents and purposes, it was operating like one.
The reason I asked, Lisa, not just semantics, I think it's an important question to ask, because I think if you are a hedge fund, you might be sitting there saying, well, what are they? Are they a hedge fund?
That's fair. And how many other family offices are there that are getting away from the disclosures and the regulation of a hedge fund by calling themselves family offices, but operating in an even more risky manner than even hedge funds themselves, John?
Tom, you understand the history of this better than most. This goes before Goldstein, it goes before TM, it goes before Dugan. And we often ask the European banks, what do you want to be when you grow up? And we still haven't figured that out, have we?
There are partitions of European banking. I'm going to look at BNP Paribas in Paris, John, as very much consumer banking, a well-run conservative clip. These are stereotypes, and people can disagree. Zurich is a world of its own. UBS clearly outperforming, but even there, UBS's relative performance to the American banks, I think most would suggest is tepid. There's just a different set of rules in Zurich. How long can they sustain that?
Tom, look at the spread. Credit Suisse is down 19% year to date. in a year where Goldman Sachs is up 27 percentage points. You go back to that City call in the last hour, different world, different execution, same climate, same place. We're operating in the same environment, and yet it's a different world for these two banks.
I'm going to cut him some slack there, maybe apples and oranges and all that. And I don't know what the apples to apples is on Credit Suisse, but I just think there's a point where patience runs out. In all the reporting this morning, John, what I really noted is Credit Suisse relationship with the Swiss elite community is what's really at focus here. It's not something you and I are focusing on now, but that matters in Zurich.
This is what I'm focused on right now. American Airlines seeing second quarter total revenue down about 40% versus 2019. I think it's important to compare things to 2019 and not 2020, Lisa, because 2020 was so bad. Tom, second quarter revenue down about 40% versus 2019, really underlining the fact that, yes, we will reopen. Yes, demand for domestic travel will be absolutely huge, humongous in the United States of America. The international story is going to look very, very different for the time being.
Ed Bastian leading on that at Delta, he told us that, I don't know, 6 weeks ago to our David Weston, and it's just the way it is, John. But to focus on the constructive international, the domestic story in America that is completely related to vaccines, case dynamics and death dynamics, cases have leveled out. That's the lead this morning.
American Airlines up by about 2.6%, and Tom's right to point out, cases have leveled out. The issue with America right now is vaccinations. Vaccinations have started to roll over a little bit as well. We'll touch on that later this hour. From New York, then, here's the price action going into the opening bell. We're shaping up as follows in the equity market. On the S&P 500, we're down a touch. We're off by 6 points for the S&P and negative a little more than 1/10%. Into the bond market, unchanged there too at 155.56 on 10s. Euro dollar, the one to watch. It's a non-decision at 7:45 Eastern for many of you from the ECB. 120.51. It has got to be about that news conference. Lisa, we'll spend the hour talking about it just a little bit, but okay, you want to front load? You want to buy more debt? Are you doing that? Is that what this is? Well, and that's what a lot of people are asking.
Yeah, and right now what you're seeing is they are front-loading the debt, but not by that much. And then what happens after June? That non-decision at 7:45 a.m., way to sell it. We've got Christine Lagarde coming out at 8:30 a.m. with the press conference. That'll be a lot more interesting. The 7:45 decision will be the ECB rate decision. Meanwhile, at 8 a.m., President Biden is going to be kicking off a two-day summit on climate change, how to fight emissions. He has pledged to reduce the U.S. emissions in half by 2030. Can he get the rest of the world on board? It's a tough sell right now, especially as a lot of countries try to battle the economic pain of the pandemic. And then at 8:30 a.m., talking about the economic pain, the U.S. jobless claims come out. Initial claims have been a messy figure. They are expected to show an increase in filings, highlighting the pain, perhaps highlighting how this is an unreliable figure in determining labor progression, John. But it really does raise a question of how quickly we're climbing out of this hole. We still do have restrictions in place.
Lisa, you're rightly putting those two together at the end there. The president will speak a little bit later this morning. We'll take some of those comments at 8 a.m. Eastern time, right here on TV and radio. The president will speak addressing Earth Day, Tom, but top of the pile is how he sells this domestically. It's about creating good-paying union jobs. In the words of this administration, it's about putting America at the epicenter of this.
John, we're at the middle, or the beginning middle, of what J.P. Morgan and Michael Ferroli say is a 7 million job creation. We got to do that before we start adding the jobs off of February of a year ago.
Got to work our way through this international pandemic as well. Forgive me from jumping from one story to another, but another headline across the Bloomberg. The Japanese Prime Minister Suga recommending virus emergency state for Tokyo. Tom, that just crossed in the Bloomberg. And this is the issue right now, isn't it? It's Japan, it's India, it's Brazil, it's much of Latin America, with maybe the exclusion of Chile at the moment, which has done a wonderful job of rolling out the vaccine.
And the compare and contrast, John, of Japan with Korea doing much, much better. And of course, all this wrapped around how they approach the Olympics. And I believe it's 93 days.
Yeah, the countdown continues. How do you approach this market? Tony Dwyer joins us now, Canaccord Genuity Chief Market Strategist. Tony, we've stalled, but you say the power is still on. What do you mean by that?
So when you think about an air show, you know, just about everybody's gone to an air show, and they see a plane screaming across the runway horizontally, and all of a sudden it pulls up and it goes straight up, and the power's on, the engines are cooking, and all of a sudden it gets up to a certain part and it just stops going up, no matter how much power is added to it, you just lose lift. And that's kind of our call for, and it's our analogy for what could happen in the market. We know that the fundamental backdrop is very positive. You know how optimistic I have been and continue to be on the macro backdrop of excess liquidity fueling a strong global recovery. That's not going to change, but that's also so well known. The markets are so overbought, enthusiasm is so high that I think we're approaching that stall speed for a little while.
Tony, I want to give you a major shout out. You've had the courage to be in the market. I put Gina Martin Adams of Bloomberg in that camp. There's others as well. David Costin at Goldman's been quite good. But Tony, you link it right into economics. Aren't we as far from recession as we've ever been?
Well, I think, again, Tom, we always try to paint each environment as unique. And of course, the reason you go into a recession is unique, and it creates a credit crisis, and it creates a Fed that is extraordinarily accommodative. So where we are economically is sort of where we were in 2004 and 2010, coming out of those kind of never before seen recessions, where you get this economic lift that creates uncertainty in the interest rate environment. What the Fed's going to do? Are they going to do what Canada did yesterday and pull back a little bit on quantitative easing? So this isn't unique. Things are good. We're at the beginning of an economic and market cycle, but in that process, you can have periods of a stall. And that's all we're talking about here, is not an economic catastrophe by any stretch, just a little bit of a market pause.
The stall speed is very much having to do with markets, not economic data, which has actually come out better than expected, notwithstanding perhaps the claims number that comes out in about 90 minutes' time. That's the expectation anyway. What are you looking for? What are markets looking for to resume that lift, that turbocharged climb into the sky, to use your analogy terribly, in order to go back into the market?
I really think, Lisa, you need to reset expectations. The next leg higher, I think, has to come from a place where people look around and say, I'm not invested enough. I think most of the data suggests that everybody's overly invested. And there's been some deterioration in the small cap world and in the NASDAQ stocks. So again, think about it this way. About 6 weeks ago, we downgraded the financials, which we had been very positive on. You know, our banks and tanks call got a lot of attention. But we downgraded the financials because we thought interest rates had seen a peak. And people were saying, how could you think that rates are going to come down on the long end with inflation expectations picking up and almost 1 million jobs being created? But that's what happened. Sometimes those fundamental factors are discounted in the market, and to create the next leg higher, which I think will happen in rates, which I think will happen in stocks, you just need that pause that refreshes, that resets expectations to a more normal level.
Tony, always great to get your perspective. You always drain the drama. Tony Dwyer, Canaccord Genuity Chief Market Strategist. It is welcome, sir. We've got a lot to get through this morning. The President of the United States will be addressing the world, re-upping, renewing the commitment of this federal government to the climate change issue. We will hear from the President in about 50 minutes from now. We need to talk about earnings in America. Southwest saying it is hopeful the cash burn will stop in June. American Airlines still sees a continued recovery. Need to talk about the macro, the ECB, a rate decision at 7:45 Eastern, a news conference 45 minutes after that. And then, Tom, we need to talk about the world of banking. Credit Suisse down by 5.76% in Zurich trading. The focus for you and I, for Lisa too, I think this morning, not so much Frankfurt right now, right. It's Zurich.
And it's a relative basis as well. You asked me about the difference. John, JP Morgan with a price to book off the PQ screen, 1.84. Credit Suisse, a little bit reduced, 0.50. It's not Deutsche Bank, but it's on the edge of Deutsche Bank.
It tells a story, doesn't it? Coming up, 8 a.m. Eastern Time, we'll be catching up with Andrew Sheets, Morgan Stanley Chief Cross-Asset Strategist from New York City this morning. Good morning. Tom Keene, Lisa Abramowitz, Jonathan Ferro. This is Bloomberg Surveillance.
With the First Word News, I'm Ritika Gupta. President Biden will pledge to cut U.S. greenhouse gas emissions in half by 2030. That nearly doubles the commitment made under former President Obama that was later scrapped by former President Trump. President Biden will convene 40 world leaders in a virtual climate summit that begins today. More fallout from Credit Suisse from the implosion of Archegos Capital. The Swiss bank expects a $654 million second quarter hit from Archegos. Plus, the Swiss regulator FINMA has asked Credit Suisse to add more than $2 billion of capital. We talk with Credit Suisse CEO Thomas Gottstein.
We are all responsible for what happened. It's now our job to take Credit Suisse to the next level. As I said, we have a lot of good elements in this first quarter we can build on. And together with the board of directors, we are doing this investigation and we will build on that.
Meanwhile, Swiss regulators are starting enforcement proceedings against Credit Suisse. Joe Biden is set to become the first U.S. president in 40 years to recognize the mass killings of Armenians as genocide. That runs the risk of upsetting an already fragile relationship with Turkey. Bloomberg's learned that the president's pronouncement will likely coincide with Saturday's Armenian Genocide Day. The killings took place under the Ottoman Empire, which later became Turkey and various successor states. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
BSO Now is your online home for brand new Boston Symphony Orchestra and Boston Pops performances. Discover new releases each week that include behind-the-scenes storytelling with conductors including music director Andres Nelsons, guest composers and musicians, plus critically acclaimed archival concerts and more. Visit bso.org/now, where the music plays on. BSO season sponsored by Bank of America.
Right now, about half of U.S. households invest. We'd like to get that number up to 95+%. Investing should be as ubiquitous as shopping online. It should just be something that people do.
The Americans' Jobs Plan is the cornerstone of the administration's approach to address climate change. It will be the most significant public investment in America since the 1960s, dramatically reducing U.S. emissions by greening the electricity and transportation sectors.
It's about creating good-paying union jobs, in the words of this administration. At the epicenter of this push this morning on Earth Day, the Treasury Secretary Janet Yellen. From New York City this morning, good morning. Alongside Tom Keene, Lisa Abramowitz, I'm Jonathan Ferro. Here's the price action. Your equity market looks like this on the S&P 500. Equities pulling back a little bit, down 0.1%. In the bond market, yields 156.09. Euro dollar 120.56. Going into a rate decision in about 30 minutes and a news conference 45 minutes after that. Euro dollar advancing 0.2%. So, Tom, here's the announcement. The president will be speaking in about 42 minutes' time. This coming from the administration. The United States announcing a new target to achieve a 50 to 52% reduction from 2005 levels in economy-wide net greenhouse gas pollution in 2030.
Certainly, John, the domestic switch here from Trump to Biden is extraordinary. Maybe we've never seen it in the history of our pollution, but it's also the international setup as well. Josh Wingrove joins us, our White House correspondent, specifically on this speech. Josh, the president wraps us around a busted Paris Agreement, which was 196 parties. Which of those parties is the president speaking to this morning?
Well, he's focusing on the big emitters, Tom, I think. Like, in particular, of course, we've got Vladimir Putin participating. And I think what we think they're going to do is try to reclaim, or, at least take a stab at reclaiming this sort of mantle of U.S. leadership. As you say, that 50 to 52% number is, in fact, double what Barack Obama had pledged. There's risk here for Joe Biden. He's sort of held together the Democratic Party in a way that people didn't really expect him to. Like, he wasn't Mr. Progressive, as of a year or so ago. This move obviously will delight that wing of the party, but will open him up to attacks that we saw from Trump and other Republicans, in particular around the impact on the oil sector, for instance. So I think Biden is walking a bit of a tightrope here. He doesn't want to lose some of those middles, but he's really managed somehow, I think, exceeding expectations to hold together the Democratic coalition.
There are many trust deficits here. You mentioned the gentleman from Russia. I don't know what his climate change strategy is on the eastern border of Ukraine, but there's all these other international issues. Is climate change discrete from those issues, or does the president adapt to other stories?
It's a little bit of an X factor, but I think they've tried to tamp it down because they've said there'll be no bilaterals scheduled as part of this. When these are in person, you get these sort of pull-aside conversations in the hallway, and that's where the real business gets done. Virtual summit, at least nothing scheduled. Very little, if not no, opportunity for sort of impromptu engagement about that. So I would I think they're purposefully punting on that. We might see, of course, that come up in further summits down the road, if and when, in particular, Joe Biden starts traveling again. But, he's coming up on his first 100-day marker. They think they've done well on vaccinations. They think they, are doing pretty well on the economy. They're starting to tout that new aid package next week. During his speech to Congress, he's going to detail the next package, the Families Plan, the third bill. And so, that one is viewed as least likely to pass Congress right now. So, a lot of moving parts for him. He's starting to pivot a little bit into his presidency, and that's the sort of backdrop of this climate summit.
Josh, just one final question for me on this climate summit. As you point out, it's the federal government that has a credibility issue here. Corporations, cities are going ahead and doing what they need to do anyway, regardless of who's in the White House. So when you set a target like this morning, that alone won't reclaim credibility. What are the policies behind this renewed effort from this administration?
I mean, it remains a very open question what power Biden has, or even what power Biden plus Congress have. He's taken steps to restrict new oil and gas development, in particular on public lands, that sort of thing. You know, there's been a question from environmental groups whether they can do more on methane. But overall, to get to this number, they say that they've crunched the numbers, and this is the number that their tools can get them to. But obviously, the proof is going to be in the pudding, and I think a lot of people will be wanting to see that, saying that this is a pretty big number to hit on your own.
Well, and the proof is also going to be on what sort of legislative proposals he can get through based on what support he has or doesn't have from the Republican leadership. Where are the Republicans on coming on board with some sort of green proposals? We know that they're on board with certain types of infrastructure spending. How much, though, on these climate reduction or carbon reduction policies?
Yeah, I'm not showing a lot of love for them so far, I think fair to say. The talk right now is whether that jobs plan might itself be split in two, sort of, Empire Strikes Back split into three little mini movies in between of the trilogy, because the one part, the infrastructure part, that could get Republican support. So the question for Democrats is, okay, we've got the second bill. Do we cut it in half, put some of it through on a bipartisan basis, and ram through the rest on our own? That is an open question right now. When Republicans talk about infrastructure, you might get them to talk about some green infrastructure in terms of energy, maybe, but really they want to stick to the sort of traditional old school OG infrastructure. We're talking, roads, bridges, that sort of thing. So really not a lot of appetite so far from Republicans on this. And Republicans are accusing Biden of having hollow pledges of bipartisanship. Of course, stalwart of the Senate, they think he's bringing them in, talking to them, and then basically ignoring them after.
And we've seen that. We've seen that before, and we'll see it again maybe as well. Josh, just quickly on diplomacy. The UK, when Biden was elected as the President of the United States, there was a belief that the outreach would come on this particular issue. There was a belief also that for China and the Chinese Communist Party, the outreach, the bridge building, would be around this particular issue. Is this a bargaining chip to avoid a collision elsewhere for the likes of China, the likes of Russia?
I think so. I think that they view it more broadly than that. I think that they view that they are only going to have chips on the table if they get in the game. And I think that's the context of them making these pledges right now. That's the context of them hosting this summit right now. And one of the big questions in the coming months is, like, will Joe Biden, for instance, attend the G7 summit in person? And that's when I think you'll start to see them, put those chips on the table, as we say, and that's when they become those bargaining chips.
Josh, I know you don't usually wake up before 8, so thank you.
I know, it's
we
just
appreciate
amazing.
It. I know, seriously. This is new, isn't it?
You're just going to
nice.
heckle him?
Thank you, Josh.
I think we ought to do this tomorrow.
We were so kind to him for so long, for a full 5 minutes. Josh, thank you. Josh Wingrove, Bloomberg White House correspondent. Josh will be back now, Tom, tomorrow morning. That's
I
it.
think
We'll see him before 8 every morning, will we?
Absolutely.
I look forward to that.
The early edition.
This is the defining issue for this administration in many ways, Tom. They're trying to sell it domestically by talking about hiring, good-paying union jobs, Buy America, America the epicenter. And I think Lisa's right to point out in the previous hour how they sell it internationally might be a little bit different.
But, John, what's so important here is what happens after the Biden administration. If we have a Democrat administration, or particularly the GOP wins, what do we do? Do we swing back to the Trump view on climate change?
That is
no
where
one knows.
The credibility issue is.
Yeah.
And Lisa, that is why it's the federal government specifically with a credibility issue. It's not the cities and it's not corporations who will continue to do what they have been doing for the last several years, the last decade.
That's why it's important to see what kinds of proposals they actually put in place that have legs that can continue beyond this current administration.
Coming up, Peter Westaway, Vanguard Asset Management Chief Economist and Head of the Investment Strategy Group on this Earth Day. Also an ECB rate decision day, 20 minutes away. This is Bloomberg.
Asia is absolutely core to our business. It's almost 20% of our franchise revenues globally, which is significantly more than most of our global peers who are more in the mid-teens.
We want to invest, grow in China, but also we are also investing in the rest of Asia as well. Our top line growth for the region has been close to 24% last year, almost 20% of the group's revenue as a percentage of the revenue of the group. So, and this is where the group is counting on the growth.
We see company after company, these are corporates committing to net zero. So pretty much across the board, there is an enthusiasm for putting capital to work to try to get us to a better carbon future.
Credit Suisse has a fantastic brand name in Asia.
Okay, guys, as you can see, position opened on Bitcoin. So all of you guys who decided to place an order and trade, we opened position on Bitcoin. I'll show you where, just right here. Okay, so stay with me. I'll guide you through all these trades. So let's see. In the difference compare with pairs, forex pairs, we calculate our profit based on percentage, 0.1%, 0.2, and so on. So here we will see how far it will go, and I'll calculate straight away if we'll be able to place stop on profit 53,097 plus 0.1%, 970. Okay, 53,917 plus 0.2%. I'm going to place straight away stop on profit for Bitcoin at 54,025. Like I told you, these days the Bitcoin quite volatile, so you have to do it before something happened, maybe hours even before something major happened with pairs or in this case Bitcoin. All right, okay, so we're already in profit. And we will see what's going to happen. What about if I will place stop on profit for 1% plus, I can even move to 1%. It will be 54,456. Am I allowed? Broker, yep. Broker allows me to do. They got quite large spread right now these days. So I'm placing stop on profit at 54,456. Okay. So this will give us £1,000 in profit. In your case, you need to find out from your broker how much broker will pay you to trade Bitcoin. Okay, I'll speak to you later. Stay safe, and we will go through this trade together. I'll speak to you later. If you want to get a strategy, you have to go to company.co.uk and you will get the strategy. You can register yourself for webinar. Next week on Wednesday we're going to have webinar, and I will explain you personally what exactly and how I trade by forex, stocks, CFDs, E-minis by using this strategy. Stay safe.
that out, but investors do seem to think that maybe a bottom is in the works. I also want to bring your attention here to Ford, which is up about 2% here in the pre-market. This is actually the second biggest volume mover in the pre-market, despite no real news here. There was an upgrade over at Wolfe Research ahead of the company's earnings next week. And keep in mind, a lot of people have their eyes on this climate summit down in Washington with Joe Biden saying this is going to put a lot of focus on the EV makers and specifically the more traditional automakers. There's this general sense here now that the beneficiaries of this push that Biden is making is not necessarily going to be those smaller EV makers. You flip up the board and you see that reflected in a downgrade that we saw earlier this morning for Fisker. This over at Goldman Sachs, basically saying that these smaller companies like Fisker, like Lordstown and Workhorse and others, they're really going to be left in the dust now that Ford, GM, and the other big automakers have finally sort of caught up here. They're basically, Goldman's basically saying this is basically now a competition between GM, Ford, Tesla, and a couple of the European automakers.
I'm really glad you bring this up because it's almost a euro equivalent to what VW and Porsche have done.
Yeah, and this is, and now everyone's saying if you look at the proposals that Biden has on the table, in order to execute some of those proposals, unfortunately, some of these smaller companies just don't really have the capacity.
I have no clue what I'm talking about. I'm just trying to pretend I'm like Matt Miller. That's all.
Well, you're doing a great job here.
Thank you.
Can I give you one other? How about one other European one for you before I leave, Tom?
Please.
Qualtrics at the bottom of your screen. That's ticker XM. If you remember, this was the customer software business of SAP that was spun off back in January this year. It really sort of languished right above that $30 IPO price. This is the biggest mover, at least on a percentage basis out there in the market, up about 15% here on the day after their earnings and a relatively bullish forecast.
Romain, thank you so much. Right now, one of the most
professional. Can you just promo the close too, Tom, before we move on?
The close is on today. Yeah, the close is on today. Taylor Riggs.
Thanks, that was good.
Romain, Caroline. Did I do that?
That's the fee.
That's the really sold it, Tom.
That's the fee we
They're
have
all
to
going
pay.
to tune in.
That's it. Am I doing okay?
You're
doing great.
Romain, thank you.
Carry on.
Thank you.
Okay, Peter Westaway with us, and this is important. He has York mathematics and really interesting pedigree out of Cambridge in operational research and economics with Nomura for years at Vanguard Asset Management now as their chief economist. Peter, I am thrilled to have you on today about the complexities of the moment for the ECB. And to me, it goes back to the heart of the matter, the almost bipolar ECB of years going back to Otmar Issing, which is the Germanic thrust of worry about inflation versus everybody else. Is that bipolar nature still in place?
I think it's definitely the case that relative to, say, the Fed or even the Bank of England, the ECB tends to put more emphasis on worrying about inflation. But let's face it, in the situation they're in at the moment where the inflation rate is very long way south of the inflation target of just below 2%, I don't think emerging inflation is anything that policymakers in the ECB are worrying about at the moment. For them, it's all about how long do they keep this accommodative policy in place to try and get the economy moving again.
Well, and there's also a question about how much they accelerate their bond buying beyond June. And we've already heard differing opinions from different members of the ECB. How much of a cohesive message are we going to hear from Christine Lagarde today? Or is this just basically a moving target depending on who you speak with?
I think it's always difficult because there are different voices on the ECB. I think she will err on the side of being more dovish than less dovish. I think it's really important to keep that signal that the ECB will do whatever it takes to get inflation back up. No doubt, the news has been quite positive lately. The vaccine rollout is just about getting going now. Some of the real economy news has been good, and even the news out of the US is going to have knock-on consequences for the EU because of the effect of the global economy. So overall, there's some good news, but I think they're not going to take their foot off the accelerator quite yet. So I think so far the bond purchases from the ECB have probably been at the bottom end of what they could have done and what people were expecting. So I think for now we'll hear about more bond purchases, and they won't be talking about taking that stimulus away for some time yet.
Peter, if we can we get into the technical detail of that? They talked about front loading in this quarter. I want to understand from your perspective whether you see evidence of that and where you look for it. Is it in net buying, gross buying? What ultimately matters right now?
I mean, I think it should come in the net buying, and I don't particularly buy that it's particularly front loaded. So I would be looking for them to carry on at the current rate, or probably for at an even enhanced rate. So maybe pushing it up to 20 billion, down from the 17, up from the 17 that they've been at so far. But I mean, in a way, the question then becomes, when do they start phasing that back, or tapering it, as some people like to call it? I don't think we'll see that really until sometime into Q3. They could even announce an increased rate of bond purchases now, but I think given what I just said about the slightly stronger outlook, the slightly better news on a range of issues, I think they're probably going to stick with what they said before and just deliver on that.
I understand that a lot of people love to ask this question, the credibility question of a central bank. Do you think they do have a little bit of a credibility issue right now? If they come out in a news conference and talk about front-loading buying, and net purchases, according to UniCredit, and we're all looking at the same numbers, are up about 10% over the Q1 average. Can we call that front-loading? Peter, you say we can't. So if we can't, has this central bank got a credibility issue?
I think that there's the fact, I use the word whatever it takes. I think it's a bit of a push to really think that the ECB are doing whatever it takes. And ultimately, one has to look at the ability over the past and now of the ECB actually hitting their inflation target, and they've struggled. And of course, there's a pandemic going on, which has affected everybody. But even going back further, they've always struggled to hit that 2% or slightly below. So I think going forward, this policy review, which is probably going to allow them to reorient their policy towards maybe hitting an average of inflation at 2%. I don't think they'll go the whole way to going to average inflation targeting like the Fed are, but I think at least to hit 2 on average rather than hit below 2 and possibly something else. I think that'll be a big step, and I think they then need to be seen to deliver on that.
They clearly need some more structure to bind the hands of the governing council. Peter, it's great to catch up to get your perspective on what's happening with the ECB. Peter Westaway of Vanguard Asset Management. In many ways, the ECB President Christine Lagarde faces the same issue that President Draghi, President Trichet faced, Tom. The hawks are making a little bit more noise.
That's the FT, did I do okay there with the bipolar thing?
I agree. The FT in the last 24 hours reporting that there are some hawks making a lot of noise over the pandemic emergency purchase program already.
I don't think a thing has changed. I mean, Axel Weber's now over holding court at UBS. But, John, on dramatically separate occasions, I've heard the same tone from Ottmar Issing that I heard from Axel Weber when he was running the Bundesbank. They're not happy with this more modern ECB structure.
Lisa, just week by week, month by month, there's just a little bit more pressure on Christine Lagarde, the president of the ECB.
Yeah, but the question to me is the economic uncertainty, and they don't really have the same pressure that the Federal Reserve has in terms of raising rates. It's the opposite, which is how much more can they ease and how much can they get people on board for that, John?
The good news, though, for the Federal Reserve is the hands are tied. They're all singing from the same hymn sheet. It is so different in Europe.
But so cut to the chase, John. You're expert at this. What is she? The first time I saw Farrell, he's standing out in front in the rain with an umbrella at the ECB. I'm going, who the hell is this guy? John, you are expert at this.
Beautiful friendship.
How's Lagarde doing?
In the economics community, there's been some pushback. Let's put it that way. This isn't my view. This is the view of a lot of people I've spoken to. There's clearly a little bit of a credibility issue here. If the ECB president comes into a news conference and talks about front-loading bond buying and net purchases are only up 10% over the Q1 average, is that front-loading bond buying? To what degree is it?
Yeah.
They're the questions she'll be peppered with a little bit later this morning.
Yeah, John, this is ex-ante transitory.
That's it.
He says it and then drinks.
I think he just wants an excuse to drink.
It's not ex-post, it's ex-ante.
You're the only person who plays a drinking game with yourself. I've never seen anything like it before.
Oh, my gosh.
You say the words so you can have a drink.
John, this started with Genesee Cream Ale.
And what do you want to now?
Well...
Yeah, there we go.
There are a couple pieces selling.
From New York City, this is Bloomberg.
Ford's gin is just outstanding in the morning.
With the first word news, I'm Ritika Gupta. Credit Suisse is raising about $2 billion to shore up capital. That's after warning of another financial hit from the Archegos capital collapse. $654 million in the second quarter. Here's Credit Suisse CEO Thomas Gottstein.
Archegos was a situation that is now being reviewed also by U.S. regulators. It was a very idiosyncratic situation with a family office which had some deficiencies in terms of disclosure. And there were 6 or 7 other brokers involved in that, so it was certainly not only a Credit Suisse issue, but we certainly had higher exposures than others.
Meanwhile, the Swiss regulator FINMA has now started enforcement proceedings against Credit Suisse. The new surge in coronavirus infections is threatening to further divide the world economy between the rich and the poor, and it could damage overall global growth if the fresh outbreaks spread or if key sources of demand falter. More people were diagnosed with COVID last week than any other since the pandemic began. Bloomberg's learned that the Biden administration will restore California's power to limit auto emissions. That's a shift that will lead to tougher requirements across much of the U.S. 2 Trump-era policies limited California's ability to set ambitious vehicle standards. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Base case is still very promising for the U.S. economy. We still have the long-term structural forces that weigh against significant acceleration in growth, aging population and others. Those structural forces should bring us back to a modest growth, relatively benign inflationary environment.
That's Brian Levitt there, Invesco Global Market Strategist. As we count you down to a rate decision from the ECB, some really encouraging headlines coming out of the airline industry after a tough couple of weeks for those stocks. Business travel return coming pretty quickly, according to American Airlines. So that's another encouraging headline out of the airlines, Tom. The mood music improves this morning, doesn't it? They're all saying the right things.
Yeah, I've seen a massive shift in business, and the pricing to me is very, very sharp. There's a lot of people saying I'm going to fly, but I'm only going to fly if I'm flying business, and that's across all the economic spectrum.
Futures down about 5 or 6 points on the S&P 500, off by 0.1%. We'll stay on top of the domestic story here in the United States of America. Got to stay on top of what's happening in Europe as well. Here's the rate decision, unchanged at the ECB. The refi rate at 0.
These are
the marginal lending facility rate at 25 basis points. The depot rate at negative 50 basis points. Rates at the present or lower levels until the inflation goal is near. The PEP program, the Pandemic Emergency Purchase Program, will run at least through the end of March 2022. The ECB will keep buying 20 billion euros a month under the Asset Purchase Program. The ECB affirming the size of the Pandemic Purchase Program of at least 1.85 trillion euros.
I hate to say this, folks, but Farrow's actually expert at this. He really actually pays attention to all this. Is this just a bunch of mumbo jumbo, John? I mean, they come out with all these headlines, which are Greek to me, and frankly, they're just moving the deck chairs on the Titanic, in this case, out to March of 2022.
Can I just say one thing?
Of course you can, Lisa. You can say more than one thing.
I mean, honestly, look, this is not mumbo jumbo. They're keeping things the same. Options trading ahead of this meeting showed that it was the least anticipated ECB meeting since the pandemic started. People expected this to be a snooze fest, for them to be moving the deck chairs for now. Really, the issue, John, is going to be the news conference,
John,
right? This is largely expected.
John, there's another headline, end of 2023. Are we just waiting, John, for the ECB headline out to 2024?
Here's the headline that I think matters right now in the near term, and we can talk about the longer term in a moment. The ECB confirming significantly faster pace of PEP purchases this quarter. So let's work through that just a little bit, because everybody's looking at the same numbers right now in the Pandemic Emergency Purchase Program. Net purchases, including redemptions, are running at about 10% above the average of the first quarter. Is that front-loading? Is that significantly faster at the beginning of this quarter? A lot of people didn't get the clarity they wanted in the previous news conference. I think they're going to be looking for that in this news conference. It's a little bit technical, I know, but that's where the focus will be in this news conference, I think, for many market participants. above and across Europe and beyond.
Just so I can translate, folks, on radio and television, when John says it's a little bit technical, what he means is, Tom, you're dumb as wood.
That's not what I'm saying, but if you want to say that about yourself, you can.
You know, I mean, it's just within the family here. Right now, on that point of clarity, let us migrate to James Athey, Aberdeen Standards Senior Investment Manager. And what's so important here, James, is you write it up as well on the poor communication. Who is poorly communicating around Christine Lagarde?
Hi, morning, Tom. Can I give you a virtual high five first? Because I kind of agree on the mumbo jumbo point, to be honest with you. I think central bank communication in general and ECB communication specifically has become really a parody, because it's you know, the theory behind this is that it's transparent communication of one's reaction function so that markets can smooth the transition between policy changes. And that's not what we get here at all. I mean, the focus, you know, John, you're talking about the pace of purchases. We have to argue over the semantics of what significantly means. You don't think 10% is significant. Maybe the ECB does. But what purpose is this really serving? I just think now it creates more distortions and creates bigger problems than it solves in any way, shape or form. So who's communicating poorly? Well, the institution. I don't think Madame Lagarde has necessarily settled down as quickly as would have been hoped. She's had several communication missteps, but more importantly, and again, Tom, you've made this point brilliantly already, this is sort of institutional within the ECB because of the very nature of you know, the people round the table and the fact that they come from sovereign nations which are not sort of formally bound together in the same way that the states of the US are. So you have different people with different domestic economic situations to deal with and different bond markets, more importantly, to report back to. And of course, that means that they have a very different view of what the appropriate path of policy is.
James, you're making a couple of points there, and they're all important ones. I think that the ECB has a credibility issue around the semantics right now. Don't think it matters so much. At a time of stress, you need real credibility. And if they can't define what significantly front-loading actually is and what it means, and if it is 10% above the average of the first quarter, then the next time they come out and there's real stress on, say, the periphery, and they say, we'll front load, and this market looks at that and says, well, we've heard this before, and front loading means X, Y, Z, then you've got a problem. So the credibility issue right now might not be a problem, but it could be in the near term. You also brought up the ECB President, Christine Lagarde. I've spoken to so many people on background, off the record, who have got an opinion on this, but don't want to talk about it on the record. James, so let's talk about it on the record right now. Why is she finding it so difficult to communicate with this market, A? And why is she finding it so difficult to get the governing council to come along with her and not talk behind the scenes and not make leaks and not do all these kind of things? What is she struggling with specifically?
So I think the first problem from the ECB's perspective is that they're so far, you know, monetary policy and the levers that they're pulling, the policies that they're implementing are just so far from monetary policy, really. It's untrue. You know, this has become very much managing financial markets first and foremost. The purported transmission from actions into inflation outcomes or growth outcomes has long since been forgotten. There's not even a pretense that this is a traditional transmission of economic policy from, you know, central bankers' words to the man in the street's actions. Nobody is even pretending that's what's going on anymore. So the policy toolkit has become very big, very unwieldy. The problem being dealt with is huge because trying to keep financial markets under wraps when the economy is structurally weak, but then goes through the sort of cyclical weakness that we all experience in Q1 to Q2 of last year, of course, incredibly difficult. And I think when you get into that technical toolkit, the fact that Madame Lagarde's background is not, you know, from a sort of theoretical economics perspective, is not a career central banker, obviously that means that she has to come up the learning curve a little, and obviously she's doing that, and I think she's getting better through time, but in trying to say nothing, to not give the market anything to go on, which I think is what she aims to do in most press conferences, she quite often confuses more than she clarifies, and we've seen this pattern of the chief economist Philip Lane issuing these blog posts in the day after the meeting, I think to try and fine-tune and clarify some of that message.
Do you think we need a little bit more structure in the communication, James? What is it that we need? What we have seen from the Federal Reserve is a shift in the reaction function, a new framework, and whether you think that's the right or wrong thing, what it has done is it's forced pretty much every single member of the FOMC right now to sing from the same hymn sheet. You don't get that in Europe. We didn't get that in Draghi's tenure either. Do we need more structure?
My honest answer to this, John, is we need less, not more. I think, go back 40 years and there was no announcement, there was no statement, there was nothing. There was a few men in a smoky room, and then you had to look at money markets to work out what decision had been made, if any at all. Now, that's one extreme. I think we're way at the other end of the spectrum. I think ultimately central bankers need to understand that they cannot manage every short-term gyration of financial markets, and to the extent that they do, they are creating as many problems for themselves when they try and exit policy as they're solving as they implement policy. And I think this is one of the things we're about to experience here. This is something that Richard Koo wrote about many years ago and has been very consistent on, and he's been very accurate in understanding and describing the world post the GFC, the QE trap. And this is the point, that it's very easy to ratchet up the amount of policy that's implemented to deal with every whips or every decline in economic activity. But actually, it's much more difficult to then try and deal with financial markets overreacting, over-extrapolating when you come to exit the policy. And I think central banks possibly this includes the ECB, certainly the hawks, they're just trying not to dig themselves into a deeper hole just yet, not until they absolutely have to.
James, as an investor, what could happen in today's press conference that could actually make you change the way you invest or what you decide to buy?
I mean, yeah, on a tactical time horizon, Lisa, obviously there can be portfolio changes as a result of things that you hear. I wouldn't expect that to be the case today. What I might expect is that some prices might change that become more attractive to change investments. I think, broadly speaking, bond yields are under pressure everywhere. I think the next phase of the sort of bond market, economic cycle, bond market transition, if you like, is for the rest of the world, the non-US, non-China world, to play some economic catch-up, and I think that probably sees yields outside of the US underperforming relative to the US. I think when you see yields rising, I don't think that's a great place for Italy to be, especially if there's any whiff of taper talk. And so if we were to see a very successful dovish message from Madame Lagarde, and we see Italian yields fall and spreads tighten, that might be something I would look to lean into, based on the fact that not a lot has changed from the headlines we've seen just now at 12:45. I think, Madame Lagarde again is going to hope that this presser is a bit of a snooze fest. But to your point, John, she's going to get asked a lot of questions about it.
Someone I got in trouble for saying that once upon a time, James.
James, it's going to be, I'm on the edge of my seat. I mean, I'm taking notes, and it's going to be, we'll have it on radio.
James can come back tomorrow, the day after. We'll do it on a weekend.
I got to be honest with you. This is the bit of the job that I probably enjoy the least. Pouring over
selling it, James. You're selling it, James. Keep it up.
You're not alone, James. You're not alone, though. James Athey, Aberdeen Standard Investment Senior Investment Manager.
Real talk.
I say technical, and Tom, you're right. You call it boring. James Athey does too, and for many people, it might be.
We'll see.
In about 40 minutes' time.
Well, and we'll have our experts on at T-Live, of course, covering every nuance of the ECB meeting. John, Rich Greenfield is always entertaining. He's out with a 37% up price target on Pinterest. Can I just say I still don't get it?
I still don't get it. Lisa, do you get it?
Lisa,
well,
do you get it?
It's working with Shopify a little bit more to advise small businesses, so perhaps that's going to give it a boost. But you get the platform? Not really.
No, I still don't get it.
But I'm not in Clubhouse, so what do I get?
Should we be doing? Should we be doing
Andrew Sheets next of Morgan Stanley and the President of the United States just around the corner too.
On Pinterest
on Earth Day with Tom Keene. What more do you want from life? This is Bloomberg.
is renewed global attention on the fact that the efficacy levels of Chinese vaccines have not reached the levels that we've seen from the mRNA vaccines in Pfizer and Moderna, and even Russia's vaccine. All of these have efficacy levels above 90%, but the Chinese vaccines are ranging between 60-something% to just below 80%. And specific attention is being paid on one Chinese vaccine, Sinovac. This vaccine has been proven in a large-scale Brazil trial to have an efficacy level of just above 50%. 50% is the minimum threshold that regulators will accept for approval. So that is concerning, especially because this is the Chinese vaccine that's been distributed most widely around the world. A lot of developing countries like Brazil and Indonesia are dependent on this vaccine. So questions are starting to mount on how is this going to affect the global immunization effort. But what's also really important to keep in perspective is that the 50% efficacy rate is looking at all symptomatic disease, even mild sickness. And the truth is that all the vaccines we have out there right now, including the Chinese ones, are nearly 100% effective at preventing hospitalization and death. And those are the two most important things: bring down serious sickness, bring down fatalities. We're still going to see that happen around the world, and that's why it's really important for people to keep getting vaccinated, even if the only access they have is to a Chinese vaccine.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
We're early on in this year. I know we've already sort of penciled in 6 or 7% growth and a big fall in unemployment, but under outcome-based policy, we really want to see that.
I'm bullish on the rebound, but I know we have a long way to go before the job is complete.
There's no textbook for this. You don't want to be too preemptive, but I also don't want to be so reactive that we're late.
I think it's too early to talk about changing monetary policy while we're still in the pandemic tunnel.
We've just been hugely stress tested here, right, with this bond yield tantrum, and sort of markets sort of survived.
Clearly, the market is going to have to navigate this transition from incredible monetary accommodation to thinking about what removing some of that accommodation is ultimately going to look like.
Where policy stance is today needs to be seen through, but absolutely, there are some tough decisions ahead.
Labor market healing is going to be a key component to our 2021 and 2022 forecasts.
We still have the long-term structural forces that weigh against significant acceleration in growth.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
Good morning, everyone. Jonathan Ferro, Lisa Abramowitz, and Tom Keene, a simulcast on Bloomberg Radio, on Bloomberg Television. In this hour, Andrew Sheets to join us from Morgan Stanley. We may get comments from our Martin Schenker. And John, in this hour, we're joined by the President of the United States.
And the President of the ECB as well. The President of the United States due to speak in the next couple of minutes, Tom. We'll get the opening remarks at the very global climate summit that kicks off this morning. The Vice President speaking first. We'll take those comments from the President of the United States. Top of the press release from the administration this morning on these new greenhouse gas reduction targets. Tom, good paying union jobs. This is a big domestic push, not just an international one.
Speaking to the domestic push and also the reaffirmation of emissions, but John, it seems to me that this is a reaffirmation of pre-Trump climate change in America. How do they do that without making it obvious?
Reaffirming that and re-upping it as well, and trying to reclaim some credibility on an issue that they lost some, maybe a lot more in the view of many people in the previous 4 years, Tom.
Lisa, what will you listen for from the president?
How he's going to sell the jobs aspect of this. We've been talking all morning about how there's sort of two prongs to this that are somewhat in conflict. The domestic story, that basically this will bring investment back to the U.S. and can create better jobs and better competition for the U.S. And then the international story, basically the world needs help and it will help us all. Well, I'm wondering what kind of teeth he has behind it, what kind of money and where it's going to go.
And where the money's going to be federal, state, or from corporations, as we heard from Mark Carney yesterday with his efforts on climate change. We've decided, of course, on surveillance to give some good coverage to this morning. John, it's something off the Paris Agreement and maybe the reaffirmation of climate change off the last 4 years, but it does dovetail into the economics of the moment, and that's Christine Lagarde at the bottom of the hour.
Well, let's talk about the economics of the moment for that central bank, Tom, and let's talk about the bond buying program. In about 30 minutes' time, the ECB president is going to get peppered with questions about the bond buying program. You told us you would front load the buying in this quarter. What does that mean? Is that what we've already seen? And that doesn't look like front loading to us. Expect a lot of questions on that. Might be boring to some people, but it matters to this bond market. If you lose credibility now, what does that mean when things get a little bit more stressful?
On the data front right now, I'm going to call it a churn to the market. Let's look at the euro 120.44 with those many calls looking up to 125. Because of the time and as we wait for the vice president and a movie to be played, and then we will bring you the president of the United States, we need to get caught up on the finance of the moment. There's no one better to do that with than Andrew Sheets with Morgan Stanley and their chief cross-asset strategist. Andrew, good morning to you. The milieu here is a boom American economy. How does your view change on allocation given the strength of the American locomotive?
Well, I think that's a great place to start. The growth backdrop appears incredibly strong. Our economists at Morgan Stanley have continued to hold an above consensus view on both U.S. and global growth. So we're certainly in that strong growth camp. But I also think we have to acknowledge that this unusually fast recovery could mean we also have an unusually fast cycle, an unusually short cycle. And thus, it's time for investors to start moving out of many of the strategies, many of the sectors that often work in that early cycle right after a recession period into things that tend to work better when conditions get a little bit more mid-cycle, when that recovery is a little bit more mature. And so those are the rotations that we're starting to make, switching out of small caps into large caps, moving into more quality stocks. I think that's going to be an important theme as, yes, growth is very strong, but I think we could be facing a cycle that looks much hotter and much faster than those that we're used to.
Andrew, I want you to build on that because I think it's lost on some people still. You've been pushing this story now for the best part of a couple of months, I think. The shorter, hotter cycle. What are the signposts you're using right now to suggest that this cycle will be shorter, it will be hotter?
Yeah, great. So I think it's fascinating because it's really kind of three overlapping cycles. There's economic conditions, there are business confidence conditions, and then there are market conditions. And if we think about the cycle, that kind of cyclical movement in very simple terms, it's about going from the low depressed levels to high elevated levels. And for the economy, it's about how quickly do you go back above trend in inflation? How quickly are you below average in unemployment? Well, those things I think will happen unusually fast. That's the view of Ellen Zentner, our chief U.S. economist. For businesses, it's about moving from caution to aggression. It's about high corporate confidence coming back. Well, you see this in business confidence surveys, that those are rapidly improving, and we think they'll continue to improve. And on markets, you're seeing it in valuations where, market valuations have already returned to kind of cyclical peaks, in many cases unusually fast. So I think those are just some of the signposts that we're watching, but I think all of that is consistent with a progression that's happening much faster than what investors have been used to over the last 30 years.
Andrew, have risk assets already priced in the peak of this hotter and shorter cycle?
I think in some cases they have. I think in some, if you look at what we're forecasting for the S&P 500, my colleague Mike Wilson has a 3,900 target for the end of this year, so we're above that. I think it's It's fair to say we think U.S. equities have priced in a lot of good news. Credit spreads are kind of near cyclical tights, near our forecasts again for the end of the year. So again, a market that we think is priced in a lot. And on the interest rate front, we think that inflation break-evens have generally hit our team's targets. We had been more optimistic that those break-evens would move higher, and we now think that needs to pause. So there are some key movements there. I would say one market that we think has not priced in, where there is still risk premium, is in EM local debt. If one FX hedges it, that's a market we've recently upgraded on the emerging market side, and that's one area where I still think there's some value.
Andrew Sheeter, Morgan Stanley, with us this morning as we await comments. Opening remarks from the President of the United States at a global climate change summit. The Vice President Kamala Harris speaking right now. Andrew, let me just turn to the domestic story in America. You're looking at peak growth in the United States. Does that mean one thing for the equity market and something else for the bond market? Do those two asset classes read into that differently?
Well, I think there's potentially, because I do think the bond market is directly linked or will be heavily influenced by what the Federal Reserve does, where I think the equity market will be influenced by both the Fed, but also the progression of earnings and a number of other factors. And, I think the key issue on the equity side, this was a component of my colleague Mike Wilson's downgrade of the small cap market is, just concerned that the margin picture is going to start to get more complicated, that you have costs that are rising in the supply chain, and those costs are not going to be equally easy to pass on to end customers, and we think it'll be harder for some of those kind of smaller, lower quality companies to do so. So now I think of the bond market side, you've seen a bond market that's already pricing in a near-term path that we think is more hawkish than what the Fed would like to do, and so that's a somewhat different picture.
Hey, Andrew, I want to do a couple of things. Stay close. We'll come back to you in just a moment. Andrew Sheets there of Morgan Stanley, the President of the United States addressing the world on climate change. Let's take a listen.
We're preserving our planet. It's also about providing a better future for all of us. That's why when people talk about climate, I think jobs. Within our climate response lies an extraordinary engine of job creation and economic opportunity ready to be fired up. That's why I proposed a huge investment in American infrastructure and American innovation to tap the economic opportunity that climate change presents, a critical infrastructure to produce and deploy clean technology, both those we can harness today and those that we'll invent tomorrow. I talk to the experts and I see the potential for a more prosperous and equitable future. The signs are unmistakable. The science is undeniable, but the cost of inaction keeps mounting. The United States isn't waiting. We are resolving to take action. Not only our federal government, but our cities and our states all across our country, small businesses, large corporations, American workers in every field. I see an opportunity to create millions of good-paying, middle-class union jobs. I see line workers laying thousands of miles of transmission lines for a clean, modern, resilient grid. I see workers capping hundreds of thousands of abandoned oil and gas wells that need to be cleaned up, and abandoned coal mines that need to be reclaimed, putting a stop to the methane leaks and protecting the health of our communities. I see auto workers building the next generation of electric vehicles and electricians installing nationwide for 500,000 charging stations along our highways. I see the engineers and the construction workers building new carbon capture and green hydrogen plants to forge cleaner steel and cement and produce clean power. I see farmers deploying cutting-edge tools to make soil of our heartland the next frontier in carbon innovation. By maintaining those investments and putting these people to work, the United States sets out on the road to cut greenhouse gases in half by the end of this decade. That's where we're headed as a nation. And that's what we can do if we take action to build an economy that's not only more prosperous, but healthier, fair, and cleaner for the entire planet. These steps will set America on a path of net zero emissions economy by no later than 2050. But the truth is, America represents less than 15% of the world's emissions. No nation can solve this crisis on our own, as I know you all fully understand. All of us, and particularly those of us who represent the world's largest economies, we have to step up. You know, those that do take action and make bold investments in their people and clean energy future will win the good jobs of tomorrow and make their economies more resilient and more competitive. So let's run that race. Win more sustainable future than we have now. Overcome the existential crisis of our times. We know just how critically important that is, because scientists tell us that this is the decisive decade. This is the decade we must make decisions that will avoid the worst consequences of the climate crisis. We must try to keep the Earth's temperature to an increase to 1.5 degrees Celsius. You know, the world beyond 1.5 degrees means more frequent and intense fires, floods, droughts, heat waves, and hurricanes, tearing through communities, ripping away lives and livelihoods. Increasingly, dire impacts to our public health. It's undeniable, you know, the idea of accelerating and punishing the reality that will come if we don't move. We can't resign ourselves to that future. We have to take action, all of us. And this summit is our first step on the road we'll travel together, God willing, all of us, to and through Glasgow this November and the UN Climate Change Conference. You know, to set our world on a path to secure, prosperous, and sustainable future. The health of communities throughout the world depends on it. The well-being of our workers depends on it. The strength of our economies depends on it. The countries that take decisive action now to create the industries of the future will be the ones that reap the economic benefits of the clean energy boom that's coming. You know, we're here at this summit to discuss how each of us, each country, can set higher climate ambitions that will in turn create good-paying jobs, advance innovative technologies, and help vulnerable countries adapt to climate impacts. We have to move. We have to move quickly to meet these challenges. The steps our countries take between now and Glasgow will set the world up for success. To protect livelihoods around the world and keep global warming at a maximum of 1.5 degrees Celsius. We must get on the path now in order to do that. If we do, we'll breathe easier, literally and figuratively. We'll create good jobs here at home for millions of Americans and lay a strong foundation for growth for the future. And that can be your goal as well. This is a moral imperative, an economic imperative, a moment of peril, but also a moment of extraordinary possibilities. Time is short, but I believe we can do this. And I believe that we will do this. Thank you for being part of this summit. Thank you for the communities that you and the commitments you have made and the communities you're from. God bless you all, and I look forward to progress that we can make together today and beyond. We really have no choice. We have to get this done.
That was the President of the United States kicking off the Virtual Leaders Summit on climate. The President addressing that summit, saying they're on a path to net zero emissions by 2050 here in the United States, re-upping, renewing, and also increasing some of the goals here in America. Tom, a clear focus on this speech, jobs. It was a word he used continuously as he addressed international leaders, good-paying jobs, moving from one industry and transitioning workers to another. We have to step up and win the good jobs of tomorrow, take decisive action now to reap the benefits of the revolution that's coming.
And it is such a difference, John. I think what we have to look back at the last 4 years and compare and contrast presidential tone and presidential quote. And what I heard there, John, was is President Biden mentioned it's a first step for him to change the rhetoric.
What I heard was an outreach to international leaders, simultaneously also, Tom, a message for the domestic economy as well. You're going to hear a whole lot more about good-paying, middle-class, union jobs from this president, and clearly a key piece of that puzzle is the climate push.
Absolutely. Martin Schenker with us, our editor-at-large, managing editor here of All That We Do. Marty, the president, to Neil Cavuto, this would be President Trump from a few years ago, talking about the con that is global warming. There's never been an abrupt change like this, has there?
No, and it's not lost on world leaders, and it's that, you know, in 4 years you can get another complete change of attitude on climate. So where is the U.S. credibility on this issue long term is the question.
Also, Marty, President Biden coming out and saying that this kicks off a race for the best jobs, that the countries that are the first movers in being more aggressive in combating climate change will be the ones rewarded with the better jobs. What kind of push, what kind of muscle is Biden putting behind this from the United States, given the lack of bipartisan support behind some of this green spending?
Well, Lisa, you put your finger right on the issue. The emission targets are quite aggressive, double what Obama's were, but you're not going to get this done voluntarily. There needs to be legislation requirements that are going to cause pain as well as opportunity in the economy. And getting politicians to agree on regulations that change behavior is going to be exceedingly difficult.
When he talks about jobs, which jobs is he talking about? Is he talking about solar and wind power plant operators? Is he talking about researchers, about electric batteries? I mean, how wholesale is this? Can we sort of quantify it in any way?
I don't know that we can. You know, he laid out in his speech just there that he sees many of these jobs being union jobs. So, you know, he would like to see them actually build things like, you know, charging stations across the country. But the key issue is how are you going to get that done through a Congress that is sharply divided?
Well, this is the issue, isn't it, Marty? Because the president moved the goalposts recently and said he wants to unite the country, not unite Congress. On this issue, does he need to unite Congress?
I think he absolutely does. And there are pockets of Republicans who acknowledge that this is something that needs to be addressed, but the question is how. The public certainly thinks that climate change is an important issue that needs to get some government response. Getting all those things to work together in a common way is going to be his task, and that of, you know, his cabinet, and Pete Buttigieg will play a large role in that.
Marty, a defining moment for this administration, that's for sure. The beginning of one. Anyway, Marty Schenker there, Bloomberg editor at large. Tom, Secretary Blinken coming out. Here's a headline for you. The Biden administration will do more than any other on climate.
John, I look at the quotes. I'm going to circle back to this, John. I know I sound like a broken record, but this is an administration that not only has to create trust, but has to create the hardest thing, which is sustained, deep, penetrating trust, and it's really hard to do in this first effort.
That goes beyond this administration, which is the key point you're alluding to. This has ramifications, implications, and consequences for investors too. This came from Bank of America on Earth Day today. They say it pays to be green. We see higher multiples for low emissions, net zero targets, and water efficiency. Higher multiples on companies that are leading that drive. Tom, I want to turn to Andrew Sheets on this of Morgan Stanley, Chief Cross-Asset Strategist. This is unavoidable now for investors, Andrew. Can you walk me through how you're approaching this issue?
Yeah, so I think something that's really important to how we're thinking about this from Morgan Stanley is something you saw the president come back to again and again there, which is investment, right? This is a huge structural investment theme, maybe one of the biggest investment themes that the U.S. and the world is going to face over the next 30 years. And, you know, it's fascinating. It wasn't more than 5 years ago when investors everywhere were really worried about a lack of investment, that, you know, we were entering this world where there just wasn't enough investment spending. There was, you know, a structural shift in CapEx, and that was driving kind of major problems for the global economy. Well, you know, kind of the green transition across a number of industries, huge secular theme. And, you know, you look at something like the utilities industry, a sector that's often seen a little bit sleepy, a little bit boring, huge transitions going on there in some companies, benefiting some companies, not benefiting others. But I think, you know, those are areas where you can see, in some cases, very interesting multi-decade runways of investment, of greening of the business. And those things, I think, have very significant implications for investors.
Andrew Sheets, where does Morgan Stanley on ESG, See in America, where 5 years and 4 months ago, our president conflated his hairspray with the ozone hole in the Antarctic. How does Morgan Stanley see the United States advancing forward on ESG as we come out of that statement 5 years ago?
Well, I think you mentioned a key point in the earlier block, that this issue of commitment is an unknown question. You know, politics can change rapidly. We've seen that in the U.S. It could change again. And so some of this is also a question of where are the economics. And so one thing that is very important, say, again, in the utilities space, is that the economics of going green are very, very good. It's not just the environmentally the right thing to do. It's often the right thing to do from a business perspective. And that makes it very sticky. You know, that means you're not counting on kind of the political wins, that you also have this other incentive driver behind it. Some of the shifts towards electric vehicles, they're not just about consumer preferences for green cars. They're about the economics, the improved economics of some of these EVs and autonomous vehicles. So I think that's a very important thing to consider, both where is the political aspect of it, but also where's the economic aspect of it, because that gives it an additional push.
Well, the economic aspect of it, or at least the financial one, is Tesla to the moon. Going forward, how much has already been baked in? I mean, how much is sort of overpriced at this point based on near-term goals versus opportunities, areas that perhaps are not factoring in a green push?
Yeah, I think, look, it's a challenging dynamic, because you have seen huge success in many of these ESG-focused companies, which is great to see, but also means you have higher valuations, more stretched valuations in some places, which creates obvious challenges. So I do think it's about looking for places where maybe the story is a little bit less exciting, but is equally important on a long-term view. Again, kind of in Europe, the utility sector is one where, again, maybe not the most exciting companies, but where you have a story of multi-year, maybe multi-decade investment that is possible over the long run.
Andrew, always good to hear from you, sir. Andrew Sheets, Morgan Stanley Chief Cross-Asset Strategist, joining us on this market ahead of the ECB decision. We've had that decision, the news conference, I should say, to be a little bit more precise. The President, Christine Lagarde, speaking in about 7 minutes' time. Initial jobless claims coming up as well. Tom, on Earth Day, we need to talk about this. I mentioned it earlier on in the programme. Know what you own. Was it Peter Lynch that used to talk about that? Know what you own. Know what you own when it comes to this as well. BlackRock put out a carbon transition readiness ETF recently. They got a ton of demand, a lot of inflows and money lining up to get inside it. And look at what's in that ETF. Top of the pile, Apple, Microsoft, Amazon, Apple, Facebook. Maybe they are the companies that are leading the transition in the United States of America. But when people buy that ETF passively, when they allocate money to it, do they know what they own?
Well, in the ETF world, I think that's dead on. And again, we go to the statistics here, John, of the R squared. What you just described is an R squared of about 0.99 to the NASDAQ. I mean, that's all there is to it. I will say that the people who are long-term pro-tech are there because of the structural change in the U.S., and that folds in to ESG.
And clearly, Lisa, there is a premium being attached to the companies that are making this push, which goes back to an earlier comment that I think we've all made this morning. Regardless of who is in the White House, there is clearly a credibility issue with the federal government. There isn't right now with corporations in the same way, or for cities for that matter too.
Yeah, but there's a difficult time quantifying what is a green push. Who's doing the best climate initiative in terms of corporations? I think Francis Donald said one of the most interesting things this morning, which is that the way they're looking at it is countries, not companies, countries that are investing more heavily in combating climate change. That is where they're looking to invest. Perhaps currencies are on a macroeconomic level. And I wonder how much that's going to become a theme going forward, John. Tom?
John, I want to mention here the president of China is speaking now. Mr. Xi is speaking. And of course, John, this is wrapped up in the immediate politics of climate change, but also the really interesting relationships here, not only between the China and the U.S., but the U.S. and Russia as well.
Three things on the radar through the next hour then. Initial jobless claims in America coming up next. An ECB news conference with Christine Lagarde and world leaders addressing climate change in a virtual summit. From New York City this morning, good morning. This is Bloomberg Surveillance.
Hamleys flagship store in New Delhi. The iconic British toy store chain is set for a revival as the new owner and billionaire Mukesh Ambani looks to expand the brand in India. Hamleys is planning to quadruple the number of outlets in India to 500 in 3 years. The expansion of Hamleys will help Ambani widen his retail portfolio as he transforms the oil and chemicals conglomerate into a consumer and technology giant.
No, I think certainly it is gaining popularity since last few years, and now more and more people are coming to Hamleys because it has a wide range of toys for all the age groups.
Founded in 1760, Hamleys has been struggling to make profit for a long time, and the pandemic has worsened its financial distress. The deep pockets of Asia's richest man and India's demographics could help Hamleys revive sales.
BSO Now is your online home for brand new Boston Symphony Orchestra and Boston Pops performances. Discover new releases each week that include behind-the-scenes storytelling with conductors including music director Andres Nelsons, guest composers and musicians, plus critically acclaimed archival concerts and more. Visit bso.org/now, where the music plays on. BSO season sponsored by Bank of America.
Valuations, particularly, sort of the technology landscape, have gotten to some pretty extraordinary levels. So I think it's not a surprise. I don't think it's any indication of the beginning of the end, but I do think markets don't like uncertainty.
From New York City for our audience worldwide, this is Bloomberg Surveillance Live on TV and radio. Alongside Tom Keene, Lisa Abramowitz, I'm Jonathan Ferro. Equity futures slightly negative, down almost 1/10% on the S&P 500. Economic data due in the United States of America. Here it is. Here's Mike McKee.
Good morning, John. Well, last week we had a big surprise because of the Easter distortions to jobless claims. They fell significantly. This time, they go down again. And that is good news for the economy because maybe some of the seasonal factors are working their way out of the data. 547,000 initial jobless claims. This is the kind of number we had been expecting. Last week, everybody said, well, okay, it was Easter. It's hard to seasonally adjust. And it is possible that some of that leaped over into this week as well, or last week as well. We don't know yet going forward, but if we continue this kind of thing, it's going to be good. This is a decrease of 39,000 from the previously revised number the week before. The lowest level for initial claims, they're saying, since March 14th, when it was 256,000, and that, of course, was the week before we started getting the amazingly high claims numbers.
Michael McKee, with the Bloomberg and with all the fancy moving averages and the exponents, we can pound through it. What I'm seeing is a curvature here. We're going from convex, which is not good, to rolling over to a concave set of moving averages. Can you call a trend change here when we move from the convex to the concave?
Well, you probably can. I'm going to be a little bit cautious and say,
agree,
this time of year, seasonal is difficult. So let's wait another week. Have me back next Thursday. We'll talk about it. If this is the trend, though, this is what we had been expecting to see for quite some time.
Claims are looking better. They need to get much better. Michael McKee, thank you. From New York to Frankfurt, Germany, we need to catch up with the president of the ECB, Christine Lagarde. Let's take a listen.
Measures continue to constrain economic activity in the short term. Looking ahead, progress with the vaccination campaigns and the envisaged gradual relaxation of containment measures underpin the expectation of a firm rebound in economic activity in the course of 2021. Inflation has picked up over recent months on account of some idiosyncratic and temporary factors and an increase in energy price inflation. At the same time, underlying price pressures remain subdued in the context of significant economic slack and still weak demand. Preserving favorable financing conditions over the pandemic period remains essential to reduce uncertainty and bolster confidence, thereby underpinning economic activity and safeguarding medium-term price stability. Euro area financing conditions have remained broadly stable recently after the increase in market interest rates earlier in the year. But risks to wider financing conditions remain. Against this background, the Governing Council decided to reconfirm its very accommodative monetary policy stance. We will keep the key ECB interest rates unchanged. We expect them to remain at their present or lower levels until we have seen the inflation outlook robustly converge to a level sufficiently close but below 2% within our projection horizon, and such convergence has been consistently reflected in underlying inflation dynamics. We will continue to conduct net asset purchases under the Pandemic Emergency Purchase Programme, also called PEP, with a total envelope of 1,850 billion euros until at least the end of March 22, and, in any case, until the Governing Council judges that the coronavirus crisis phase is over. Since the incoming information confirmed the joint assessment of financing conditions and the inflation outlook carried out at the March monetary policy meeting, the Governing Council expects purchases under the PEP over the current quarter to continue to be conducted at a significantly higher pace than during the first months of the year. We will purchase flexibly according to market conditions and with a view to preventing a tightening of financing conditions that is inconsistent with countering the downward impact of the pandemic on the projected path of inflation. In addition, the flexibility of purchases over time, across asset classes, and among jurisdictions will continue to support the smooth transmission of monetary policy. If favorable financing conditions can be maintained with asset purchase flows that do not exhaust the envelope over the net purchase horizon of the PEP, the envelope need not be used in full. Equally, the envelope can be recalibrated, if required, to maintain favorable financing conditions to help counter the negative pandemic shock to the path of inflation. We will continue to reinvest the principal payments from maturing securities purchased under the PEP until at least the end of 2023. In any case, the future roll-off of the PEP portfolio will be managed to avoid interference with the appropriate monetary policy stance. Net purchases under our Asset Purchase Programme, APP, will continue at a monthly pace of 20 billion euros. We continue to expect monthly net asset purchases under the APP to run for as long as necessary to reinforce the accommodative impact of our policy rates and to end shortly before we start raising the key ECB interest rates. We also intend to continue reinvesting in full the principal payments from maturing securities purchased under the APP for an extended period of time past the date when we start raising the key ECB interest rates, and in any case for as long as necessary to maintain favorable liquidity conditions and an ample degree of monetary accommodation. Finally, we will continue to provide ample liquidity through our refinancing operations. In particular, the latest operation in the third series of targeted longer-term refinancing operations, TLTRO III, has registered a high take-up of funds. The funding obtained through TLTRO III plays a crucial role in supporting bank lending to firms and households.
Traders, we need to place stop on profit even higher, up to 2%. So I'm going to place stop on profit at 54,996. It will be 2% stop on profit. If you start following my trade, please do so. Please place stop on profit at this level. This way, if Bitcoin will change direction, you will close your trade in profit. Okay? Okay, 54,996. Great. Nice trade, yes? Okay, guys. I'll speak to you later. Stay safe. We have plenty other pairs. I can see Euro want to do something, and I'm waiting confirmation from our indicators and strategy we use will send me confirmation that time came to place trade on Euro. Okay, stay safe, and I'll speak to you later.
And firms, but consumers remain cautious in view of the pandemic and its impact on employment and earnings. Despite weaker corporate balance sheets and elevated uncertainty about the economic outlook, business investment has shown resilience. Looking ahead, the progress with vaccination campaigns, which should allow for a gradual relaxation of containment measures, should pave the way for a firm rebound in economic activity in the course of 2021. Over the medium term, the recovery of the euro area economy is expected to be driven by a recovery in domestic and global demand, supported by favorable financing conditions and fiscal stimulus. Overall, while the risks surrounding the euro area growth outlook over the near term continue to be on the downside, medium-term risks remain more balanced. On the one hand, better prospects for global demand, bolstered by the sizable fiscal stimulus, and the progress with vaccination campaigns are encouraging. On the other hand, the ongoing pandemic, including the spread of virus mutations and its implications for economic and financial conditions, continue to be sources of downside risk. Euro area annual inflation increased to 1.3% in March 21 from 0.9% in February, on account of a strong increase in energy price inflation that reflected both a sizable upward base effect and a month-on-month increase. This increase more than offset decreases in food price inflation and in HICP inflation, excluding energy and food. Headline inflation is likely to increase further in the coming months, but some volatility is expected throughout the year, reflecting the changing dynamics of idiosyncratic and temporary factors. These factors can be expected to fade out of annual inflation rates early next year. underlying price pressures are expected to increase somewhat this year, owing to short-term supply constraints and the recovery in domestic demand, although they remain subdued overall, in part reflecting low wage pressures in the context of economic slack and the appreciation of the euro exchange rate. Once the impact of the pandemic fades, the unwinding of the high level of slack, supported by accommodative fiscal and monetary policies, will contribute to a gradual increase in inflation over the medium term. Survey-based measures and market-based indicators of longer-term inflation expectations remain at subdued levels, although market-based indicators have continued their gradual increase. Turning to the monetary analysis, the annual growth rate of broad money stood at 12.3% in February 2021, after 12.5% in January. Strong money growth continued to be supported by the ongoing asset purchases by the Eurosystem as the largest source of money creation. The narrow monetary aggregate M1 has remained the main contributor to broad money growth, consistent with a still heightened preference for liquidity in the money holding sector and a low opportunity cost of holding the most liquid forms of money. Overall, lending to the private sector remained broadly unchanged. The monthly lending flow to non-financial corporations showed a modest pickup in February compared with the previous month. This was also reflected in a slightly higher annual growth rate of 7.1% after 6.9% in January. Monthly lending flows to households continued to be solid, with the annual growth rate of loans to households remaining unchanged at 3% in February. The latest Euro area bank lending survey for the first quarter of 2021 reports a moderate tightening of credit standards for loans to firms, following more significant tightening in the previous 2 quarters. Heightened risk perceptions among banks were again the main contributor to the tightening, although their impact was less pronounced than in previous survey rounds. Surveyed banks also reported a renewed fall in demand for loans to firms, mainly driven by a continued decline in demand for financing for fixed investment. With regard to lending to households, the survey indicated lower demand for loans for house purchase, while the credit standards for these loans eased slightly, supported by competition among lenders. Overall, our policy measures, together with the measures adopted by national governments and other European institutions, remain essential to support bank lending conditions and access to financing, in particular by those most affected by the pandemic. To sum up, a cross-check of the outcome of the economic analysis with the signals coming from the monetary analysis confirmed that an ample degree of monetary accommodation is necessary to support economic activity and the robust convergence of inflation to levels that are below but close to 2% over the medium term. Regarding fiscal policies, an ambitious and coordinated fiscal stance remains crucial, as premature withdrawal of fiscal support would risk delaying the recovery and amplifying the longer-term scarring effects. National fiscal policies should thus continue to provide critical and timely support to the firms and households most exposed to the ongoing pandemic and the associated containment measures. At the same time, fiscal measures taken in response to the pandemic emergency should, as much as possible, remain temporary and targeted in nature to to address vulnerabilities effectively, and to support a swift recovery of the euro area economy. The three safety nets endorsed by the European Council for workers, businesses, and governments provide important funding support. The Governing Council reiterates the key role of the Next Generation EU package and the urgency of it becoming operational without delay. It calls on member states to ensure a timely ratification of the own resources decision, to finalize their recovery and resilience plans promptly, and to deploy the funds for productive public spending accompanied by productivity-enhancing structural policies. This would allow the Next Generation EU program to contribute to a faster, stronger, and more uniform recovery, and would increase economic resilience and the growth potential of member states' economies, thereby supporting the effectiveness of monetary policy in the euro area. Such structural policies are particularly important in improving economic structures and institutions, and in accelerating the green and digital transitions. We now stand ready to take your questions.
Thank you very much, President Lagarde. And today, the first question goes to Luke Heighton of Market News International, MNI. Luke, please, over to you.
Good afternoon, President Lagarde. Can you hear me okay?
Yes, very well.
Excellent, thank you. Two questions, if I may. Firstly, I'd be interested to hear whether you think the outlook is improving sufficiently, as your colleagues Mr. Knoss and Mr. Holtzman have suggested, to consider slowing the pace of PEP purchases from the third quarter of this year, and whether this was something that was discussed at today's meeting. And then secondly, I'd be interested to know whether the move higher in the euro in the last couple of weeks to levels above 120 was also raised in the meeting in the context of wanting to prevent a premature tightening of financial conditions. Thank you.
Well, thank you very much for your question, and really it gives me a chance to go back to the key part of our deliberations, which has to do with really taking a good look at the economic situation, both from a growth perspective, from an inflation perspective, from the financing terms that are available in the context of forming our joint assessment. So, in terms of outlook, it's very much a on the one hand, on the other hand situation, because there are clearly signs of improvement that are coming from, essentially an improvement in the rollout of the vaccination plans in most euro area countries. That's on the one hand. On the other hand, we are clearly seeing continued contagion, continued pressure put upon some of the economic sectors as well as the health sectors. And equally, also on the sort of more negative side of things, we are seeing the risk of potential evolution of the virus, variants that can constitute a threat. And we still have this overall environment of uncertainty about the economic situations that really surround the near-term outlook. And I think it is very much reflected in the consumer's behavior, because when you look at the retail sales, for instance, they rose in February, but they remain certainly well below the pre-pandemic level and well below the fourth quarter of 2020. That's an indication of consumer confidence. On the other hand, you have now a service sector that seems to be bottoming out, which is still in contractionary territory. The PMI on services is, if I recall, at 49.6, so short of the 50, but heading in the right direction. And let's not forget that this was the sector that was most affected by the economic recession. So it's very much, as I said, on the one hand, on the other hand. That's for the economic outlook. If we look now at the risk assessment that we always conduct as well, we still have the same risk assessment as we had back in March. We still see near-term risks tilted to the downside, and we still see medium-term risks much more balanced. So overall, everything that we have looked at in terms of high-frequency indicators, latest information, data, surveys, really confirm the projection that we had back in March. That's on all accounts, and in terms of inflation numbers, we're also on the same page as we were with our projections back in March. So that's against that background that we conduct our joint assessment. Now, you asked me a second question, which had to do with the appreciation of the euro. We do not target any kind of exchange rate, but we monitor very carefully exchange rate and variations, because clearly that can have a downside impact on prices, and we are very attentive to that. Thank you.
Thank you very much. And the next question goes to Isabella Bufacchi of Il Sole 24 Ore. Isabella, please.
Yes, hello, and thank you for the opportunity. President Lagarde, I have two questions. The first question is, again, on the PEP purchases. The Governing Council, as you said, expects over the current quarter PEP purchases to continue to be conducted at a significantly higher pace during the first quarter of this year. And my question is, what is your assessment of this decision so far? That is, are financing conditions at the moment as favorable as the Governing Council would like them to be? And my second question is on a possible link between the next generation EU and monetary policy. As you mentioned, that the Governing Council has reiterated the key role of next generation EU and the importance of coming without delay. So can we assume that a long delay of next generation EU or a premature fiscal tightening by EU members could lead to longer ample accommodation by the ECB? Thank you.
Well, thank you very much. I'll take your second question first, because really it's a case of everybody having to do their job and everybody having to comply with their respective mandate. Our mandate is price stability, and we are riveted to the aim that we have under the circumstances. So next generation EU is clearly in the fiscal domain, as are some national decisions that have been made, that are being made, and fiscal authorities have to do what they have to do. We certainly complete each other, complement each other, but we are not substitute. And if there was, delay or any hurdles that would not be overcome, it's not a question of substituting, because we are complementing each other, each of us in our respective area and with our respective mandate. On the PEP purchase, you did pick up that in the introductory statement we decided to keep the pace of purchase at a significantly higher pace. And I just want to remind you that when we do that, it's with a view to preserving favorable financing conditions. And when back in March, we observed the financing conditions, we decided that we had to take action, and we significantly increased our pace of purchase. That was clearly the case. That decision was made on the 15th of March and was readily implemented, not for the entire month, which is really the relevant period of time when you want to assess the pace of purchase. But so we implemented right away as of the 16th of March, and we have continued doing so without any wavering, and in a very determined and decisive way. There's been a clear and significant increase in that pace of purchase. And it will continue to be that way because, as I said earlier on, Our assessment of the economic situation is broadly the same, and the joint assessment that we do on an intermediate basis, as opposed to the comprehensive assessment that we conduct at the time of the projections, also lead us to believe that we need to continue those purchases at this significantly higher pace than during the first 2 months of 2021.
Thank you. And the next question goes to Carolyn Look of Bloomberg News. Carolyn, please.
Hi, good afternoon, President Lagarde.
Good afternoon.
First of all, hi. I just wanted to follow up, first of all, on one of the previous questions about a gradual phasing out of PEP purchases in the third quarter. I'd like to know what the ECB would need to see in order for it to return to its normal pace of purchases. Would this be a confirmation of the economic outlook that you saw in March, as your colleague Klaas Knot suggested in a recent interview? Or would you need to see an upward revision to your forecasts or an end to restrictions? What can you tell us about that? And second of all, in terms of financing conditions, which you were just speaking about, your bank lending survey this week showed that banks expect to tighten credit standards even further in the current quarter, after they've already done that in the past 3 quarters. So is that a worrying sign in your assessment, and what is the ECB doing about that?
Okay, thank you for your question. On the first one, let me just assure you that on the occasion of this Governing Council, we did not discuss any phasing out of PEP because it is simply premature. I would also observe that any determination concerning the pace of purchase under the PEP is done not on a date or a calendar basis. It is data dependent. We have pledged to preserve favorable financing conditions. We conduct a joint assessment of those financing conditions throughout the whole spectrum, and the inflation outlook. And it's the combination of the two, the financing conditions and the inflation outlook. It's on the basis of these two elements, which are quite complicated in their own respect, each of them, that we determine the pace of purchase. That's what we have done this time around on an intermediate basis. We will do it again in June when we have the projections, but any phasing out was not discussed, and it is just premature. On the bank lending survey, I would just remind you that statement that loans in volume numbers have actually slightly increased over the last quarter, and that is for the non-financial corporate sector, and has remained roughly the same for the households. That's, of course, backward-looking. The BLS is forward-looking and translates really the sentiment and the views of banks as to their future activity. And this BLS, as far as the sentiment about their future activity, indicates two things. One is there is moderate tightening, as opposed to much stronger tightening in the 2 previous surveys. So while it is still tightening, that tightening is moderate. And second, there is the view by banks for their future activity that there will be less demand originating from the non-financial corporate sector on the ground of less needs for investment and capex in particular. That's what we are taking away from the BLS. But the third point that we take away as well, and that's what banks are actually saying, is that TLTROs, TLTRO 3 in particular, of course, PLTRO to a certain extent for some banks, are playing a critically important role in helping with their lending operations. And the recent take-up that we have seen back in March of the latest TLTRO operations is evidence of the fact that banks are drawing benefits from those TLTROs under the condition, I remind you, that they continue and extend lending to the economy, at least on a par with what they were doing pre-pandemic. Thank you.
Thank you very much. And the next question goes to Francesco Canepa of Reuters News. Francesco, please, over to you.
Yeah, good afternoon.
Good afternoon.
So, you said the main goal of PEP is to keep financing conditions favorable. Are you happy with the current level of bond yields, nominal and real? And the second question is about PEP again. You often accompany your weekly data with warnings that redemptions affect the net numbers. So can you tell us more about how redemptions affect your ability to buy more bonds? Is it that you're struggling to find enough bonds to buy in certain jurisdictions or maturities? Can you tell us more about that?
Okay, so one thing that you got absolutely right, and it's probably because I have repeated it extensively, is that our pledge is to preserve favorable financing conditions. And as a result of that, back in March, we significantly increased the pace of purchase, and we have decided today to continue to proceed at this significantly higher pace of purchase relative to the first 2 months of 2021. When we look at the financing conditions throughout the chain, from upstream to downstream, we are...
Position closed on Bitcoin, guys. As you can see, we closed our position. It took us a couple of hours from 12 o'clock, right now 2 o'clock, to complete this position. So well done, all of new traders, you become day traders. So you did quite well. In our case, we made £2,000. In your case, how much broker pays you? We made 2% from the beginning until the end. Okay, if you want to get the strategy, you need to buy it. It's not free, and you can go to company.co.uk website and you will get the strategy. As you can see on the screen, you can get webinar, 1 hour webinar. The webinar includes strategy, so I will follow you through this strategy and I will explain you how we trade. We've been trading since 90s and we use this strategy for a very long time. We trade all major stocks, CFDs, E-minis, Forex, Bitcoin, anything that gives us profit. We're not investors, we're day traders, so this is the difference. We make money on daily basis. These days, we believe it's kind of difficult to find stock, if you're not in control of this stock, to buy 50 or 60% of holdings and make a profit from it, because lots of other factors can change direction of the stock, and even if stock will produce profit through yearly sales, the stock might go down because FTSE will go down, or depends where the stock's located, in what kind of UK or American territory. So this is all difficult these days to find, but if you want to become a day trader, here's your chance. You can get a strategy and you can start trading quite profitably. I will calculate everything. You probably received already from your brokers confirmation, and they said already they send you your profit, 2% profit on Bitcoin. That's not bad. I'll speak to you later. Let's move on. And let's look for another chance and opportunity to make a profit from day trading. Stay safe.
In our early 40s from the German Environmental Party and former trampoline champion,
with no experience in governing issues, but she was nominated for the political race to succeed Ms. Merkel later this year. This means that Ms. Baerbock, to name her, could therefore potentially be the leader of the largest European economy. So what is your take on this kind of news? Thank you.
Well, thank you so much for these two questions, actually. You know, on the phasing out and the transition question that you had, as I said, this matter was not discussed because it is premature. We still have a long way to go until we've crossed the bridge of the pandemic and the recovery is sustainable, solid. I've referred to an economy on crutches, one fiscal crutch, one monetary crutch, and I do believe that this image speaks for itself. The economy of the euro area, the economies of the euro area have to go across the bridge of the pandemic and have to be on solid and sustainable ground in order to sort of walk on a self-sustained basis. Now, obviously, we look at what other central banks around the world do on a regular basis. All banks included, Canada, Japan, the Fed, the Bank of England, all of them, because we are a close-knit and we appreciate what is being done, why, and each and every country has its own specificity and its own accompanying measures that complement their monetary policy. I'm referring here to fiscal plans that can be significant. On your second question, I mean, the first conclusion I draw is that competitive sports in all categories, whether it is synchronized swimming or trampoline, can actually equip you with a little spirit of competition, hard skin, and the desire to excel in your sports, but also in politics if one desires to go into politics. This clearly seems to be the case with Mrs. Baerbock. The second lesson I would draw is that you don't need to be a seasoned gray hair or white hair person to enter into politics and be recognized for your own talent. So I very much welcome an athlete, a young woman, and certainly one who has a very high concern for climate issues and protection of the environment, which, as you know, on a personal basis, I care for.
Thank you, Madame Lagarde. The next question goes to...
I would add another point, actually. It also shows that Chancellor Merkel has not discouraged younger women to enter into politics. And that's a very high tribute to a woman who has led this country, where we are currently, Germany, for 16 years. It's the value of role models.
Thank you. The next question goes to Martin Arnold of the Financial Times. Martin, please.
Hello, Madame Lagarde. Can you hear me?
Yes, I can hear you, Mr. Arnold, very well.
Fantastic. So my question is on the first question on the outlook. You've said that all the information that you've processed is very much in line with the assessment you had back in March. Does that mean that it still fully supports your forecast for a second quarter growth rate in the Eurozone of 1.3%? And secondly, what would it take for the ECB to decide to return to the normal pace of PEP purchases in the third quarter in June when you publish new economic forecasts? Thanks very much.
Well, thank you very much. You rightly pointed out that our intermediate assessment and our review of existing data, information, high-frequency numbers, and all the rest actually confirms our projection of March. And obviously, I'm not going to give you any specific number concerning a particular quarter, because that will be done when we publish our projection next June. But overall, what staff of the ECB is saying is that their projection are very much confirming, or rather the current economic situation and the outlook as we see it at the moment are confirming the direction of their projections as published in March. And they also confirm that while the first quarter might we are very attentive, but might very well be negative. On the other hand, the second quarter is pointing to a positive outcome. Now, your second question puzzles me a little bit because I don't know what is the normal pace of purchase of PEP. We decided in December to no longer be operating on the basis of a linear volume, but we decided to commit to preserving favorable financing conditions. And that is a determination that we made in December, that we demonstrated in March, that we observe now, and that will guide our assessment, a joint assessment, comprehensive this time, next June. So there is no normal pace of purchase. There is a commitment that has been made. There's a joint assessment that we are bound to make either at an intermediate level when we don't have the projections or on a comprehensive basis when we have the projections to actually jointly assess favorable financing condition throughout the supply chain of financing and the inflation outlook and the impact that one has over the other with a view to returning to the pre-pandemic inflation path, which is clearly going way or some way into the inflation aim that we have, which, as you know, is close to but below 2%.
Thank you. And the next question is for Annette Weisbach of CNBC. Annette, please.
President Lagarde, thank you very much for this opportunity. I have a question on the slack in the economy. We've been hearing from the Bank of Canada that they are quite optimistic that by the second half of 2022, the slack will be absorbed. Are there any estimates also for the Eurozone? And then I try my luck again with a question on what you think about would be appropriate in terms of moving in tandem or not when it comes to tapering, because I think the market view is that the ECB could not act before the Fed, so they would have to wait when it comes to any exit scenario. What's your view? Thank you very much.
Don't take me literally, but it would be nice to move in tandem with the Fed, because that would mean that our inflation numbers are aligned. Now, clearly, Fed is dual mandate 2%. With employment, we are close to but below 2%. But if you look at where the Fed is, where we are, when you look at expectations in the United States and expectations in the euro area, we are not on the same page. So it would clearly predicate that we will not operate in tandem with the Fed. I think that's very much a given, and it's not me looking into a crystal ball. It's, where we are, and it's pretty obvious. So slack in the economy. Our assessment at this point in time is that the euro area economies will return on average to the pre-pandemic economic level in the second half of 2022. And I'm taking precautions here because when I say on average, there will be divergences, there will be heterogeneity. There will be countries that will be lagging behind because of multiple factors. But on average, we are seeing the euro area economy back to pre-pandemic level, second half of 2022. It doesn't mean that all slack will have been absorbed because my take is that entering into pandemic, there was some slack. And my hope as well is that there will be as many jobs newly created and that the ECB will contribute to such developments by delivering price stability as our mandate so requires. Thank you.
Thank you. And the next question is for Barbara Schäder of Stuttgarter Zeitung. Barbara, please.
Hello. Question on negative interest rates, if you please. Here in Germany, we see an increasing number of banks passing on costs of negative interest rates to private customers. and especially even on deposits of 25,000 euros or lower. So do you understand that this upsets people, and could you please explain once more why negative interest rates are necessary? Thank you.
Well, as you know, interest rates are the traditional tool of monetary policy. And based on our experience, the negative interest rates are continuing to be an effective tool for providing monetary policy accommodation. I think we have clear evidence that cutting rates below zero provides additional stimulus to the euro area economy, as rate cuts are passed through the bank lending rates and overall financing conditions of firms and households. Now, in the whole of the euro area, negative rates are passed on to corporates to a large extent. Not all banks do that, but many banks do that in the euro area. As far as households are concerned, it's 5% of deposit accounts of households that are imposed negative rate consequences by banks. It's higher than that in Germany. It's double that amount. So based on our numbers, based on the data provided by banks, it's 10% of those deposit accounts. But I think we need to be, I completely appreciate that people who are saving are not satisfied with being charged the consequences of negative rates. But we have to look at the situation from a global point of view. We cannot look at a particular depositor or a particular category. We have to look at the whole economy. And we know that by putting in place those negative interest rates, we are effectively supporting the economy. We are encouraging enterprises, families, households, young couples to actually borrow at very low rates in order to invest, in order to buy their first apartment, in order to buy some equipment. And, the contribution that is in order to support the economy, in order to make sure that jobs are kept, in order to make sure that corporates can continue to operate and produce, is clearly a trade-off against some aspects that are resented by those that are only savers and are not borrowers. But in every household, you have savers and you have borrowers. So there is always a trade-off, and we have to look at the aggregate euro area economy ourselves and deliver on our mandate.
Thank you. And the next question is for Johanna Träg of Politico Europe. Johanna, please.
Yes, thank you very much. I've got a question on the strategy review. Could you give us a better idea of the timing when you can actually share your results with us? And has the Governing Council seriously discussed any other options beyond the more symmetric target and dropping the monetary pillar? Thank you very much.
Thank you for asking a question on a project that keeps many of our very talented staff busy at the ECB, but also in the national central banks, because that's really a project where everyone is involved and everybody is contributing. We are well into the second half of our strategy review. We have already covered a lot of ground. We still have more work to do and more seminars that are planned in the weeks ahead. My commitment is that we will deliver on our strategy in the fall of 21. If we manage to conclude our set of seminars and to conclude our deliberation to arrive at this new strategy before that, then of course we will come to you and to Europeans and to the European Parliament and to all those that we are accountable to earlier than that. But the fall of 21 is clearly the deadline that we have set for ourselves in order to deliver on the strategy and its outcome. We are looking at multiple options, proposals, views, recommendations, and we are not yet landing in any particular zone that will be the ultimate conclusion, because we need to keep all options opened. This is a commitment that I have made to the Governing Council members as as I'm leading this exercise, I promise that we will not deliver until everything has been examined and conclusions have been reached. So there are many proposals around, some, more attractive, others more alternative, but we'll get there when we get there.
Thank you. And the next question is for Andres Stumpf of Expansion. Andres, please.
Good afternoon, Madam President. Do you hear me well?
Yes, thank you very much. Good afternoon to you.
Good afternoon. I would like to know your opinion about the pushback that any sort of explicit yield curve control seems to get from several members of the Governing Council. Is that strategy completely off the table, and would it be something worth discussing as the Governor of the Banco de España suggested recently? Thank you.
Well, thank you very much for your question. As you indicate, as I just indicated in the previous response, we are looking at multiple options, multiple proposals as far as our strategy review is concerned, and that's a track in and of its own. Now, we also have our business as usual track of business, which consists of deciding monetary policy every 6 weeks. And on that particular track, we are guided by the decision that was made in December, which is not yield curve control, but which is the commitment to preserving favorable financing conditions. I know it's a little bit more subtle, it's a bit more complicated. It requires that we analyze the financing terms that are available from risk-free rates all the way down to terms and rates available for corporates and households, and the inflation outlook and the impact that one has over the other. It's more complicated than having just a yield definition that we would just abide by. But this is not the choice that was made. So we are loyal to the decision that was made in December, applied in March, reiterated in April, and that we will also take into account to calibrate our monetary policy decision in June.
Thank you. And the next question is for Tom Fairless of the Wall Street Journal. Tom, please.
Hi, Madame Lagarde. Thanks for taking the question. I had a question about tourism, which is a significant part of the economy in Southern Europe, especially. Do you think how much is the season this year going to be saved, and how much of that is a problem for your forecast for the Eurozone economy if tourism in Southern Europe does quite badly? The second question was on government debt. And there's a debate among economists about how much debt governments can safely hold. In the US, they seem to be thinking the government can support a lot more government debt. Do you think that European governments can safely have a lot more debt in the future, so significantly above the 60% Maastricht target, for instance? Thanks.
On tourism, I think we are both well placed to address the question. Do you want to take it? The one on tourism, because Spain is clearly one of the countries that has fantastic tourism.
Well, I think that is going to depend on the evolution of the vaccination process. If vaccination rollout gains momentum, and we expect that it's going to gain momentum, we hope that a high percentage of the population will be vaccinated, and that this is a positive sign, a positive indication that perhaps the summer season will not be totally lost as it was in 2020. So vaccination is going to be the driver, in my view.
Yeah, and I think in quite a few of those countries, we are seeing a gradual acceleration of the vaccination pace, and that's really much in demand for those economies that are particularly sensitive to the social distancing rules as tourism can be. So on the debt question, all countries around the world and the euro area countries are no exception, but all countries around the world had to increase their debt because they had to respond to the worst possible crisis that the economies had in post World War times. So there was just no question as to whether or not the 60% threshold should or should not be exceeded, and whether you were below the 60 or way above the 60, debt had to be increased, full stop. The real question is what use is made of debt now going forward, because it's clearly the use of debt in the first few months of the pandemic had to do with keeping the economy afloat, making sure that businesses were not going down the tube, making sure that people were not left without income. The real question now is what use is made of debt? Is the public spending targeted and temporary in order to cross the bridge of the pandemic, as I have indicated earlier in the first instance? And second, is this public financing going to be spent on productivity-enhancing reforms that will actually improve the growth potential of those economies? And if that is the case, and financing terms remain attractive relative to the growth that can be developed as a result of those targeted temporary measures and productivity-enhancing measures, then this is debt put to good use. I think that has been described much more so than by fiscal authorities and governments than by me. And clearly this is a matter that will be reviewed by the European Commission, by the European Council members in order to redefine the terms of the Stability and Growth Pact. But this is a matter which is not for the European Central Bank to decide. Thank you.
Thank you. And this brings us to the end of today's press conference. We would like to thank everybody for their participation and their interest. The next press conference is scheduled for June 10th. So if you would like to dial in, we would be very happy. And up until then, please stay safe and stay healthy. Thank you and goodbye.
June 10th is in the diary for the next ECB news conference with President Christine Lagarde over in Frankfurt, Germany. I think for many of you out there, you feel the same. You're often reminded of the former Fed chairman, Alan Greenspan, and this quote: "I know you think you understand what you thought I said, but I'm not sure you realize that what you heard is not what I meant." No change at the ECB since the last meeting, and in many ways no change in this market either. Here's the price action. Euro-dollar looks like this for the single currency. Euro-dollar pretty much unchanged on the day, 120 flat. In the equity market going into the opening bell, equity futures pretty much unchanged too on the S&P 500. Russell futures up by about 1/3 of 1%. Nasdaq futures down by a little more than 1/10 of 1%. I'm pleased to say that joining us out of Frankfurt, Germany, is Paul Gordon, leading our ECB coverage over in Frankfurt. Paul, your initial reactions to this news conference today, please.
Yeah, very much steady as she goes, wasn't it? There were two main issues at the fore here. One was whether the ECB would step up its pace of pandemic bond buying even more than currently, whether it's doing enough. And Lagarde was quite insistent that financing conditions have remained favourable. They judged back in March that more was needed, more was done, and she's satisfied with progress so far. And the second one was whether the emergency purchase programme will start to be phased out, or talks will start on phasing it out. And she said that's not even being discussed at the moment by the Governing Council. So at the moment, it's a case of the recovery is coming, but it's not here, so the support remains.
Paul, I can't decide whether we're sort of overly focused on semantics. And when I say we, I mean some of the people I speak to in the market right now. This definition of significant increase, stepping up the purchases, front-loading them. Paul, what do you see in the data? And what are they defining significant increase by? What do they say it is?
Yes. Well, I mean, at the start of the year, we were seeing an average purchase pace of about 14 billion euros a week. Now we're seeing about 17 billion euros a week. So it's not huge. That's net purchases. And Lagarde was quite keen to stress that you shouldn't look at the weekly numbers. You should look at the monthly numbers, i.e. give some time to smooth out the differences. And one of those differences comes in redemptions. The gross purchases last week were actually very high, the highest since June, but there was a very large redemption. I think ultimately that what you have to look at is bond yields bank lending conditions, they're all slightly tighter than they were, at least in nominal terms, than March. But clearly the ECB is comfortable with that. So its current pace of purchases seems to be roughly where it's staying for the moment.
Paul, I guess if it's boring, it's probably a good thing right now for Europe that things start to improve and they're less exciting, eh? Paul Gordon out of Frankfurt, Germany. Thank you, sir. It's good to see you. Joining us now is Invesco's Alessio De Longis and Stephen Englander of Standard Chartered. Steve, let's just start here. I know it's something that's occupying the minds of a lot of ECB watchers right now, just the pace of purchases. Should we be focusing on weekly net buying? The ECB says no. Have you got the clarity you need right now, Steve, from this ECB?
Well, they're deliberately not or trying to be unclear in what they're saying. I mean, we see a very modest pickup. It could be that there's more pushback on the governing council than was anticipated earlier. There's also a question, you buy bonds, government bonds, unless it leads to some kind of action in the economy, either more spending or bigger fiscal stimulus or something like that. It's not doing much on the rate side, which is largely being driven by U.S. rates. So, much of this is symbolic to begin with. I think initially, at least, the market was scratching its head about why so much fuss over a very, modest pickup in buying.
Alessio, your thoughts, please.
I very much agree with my dear friend Steve. Look, when we're focusing on the bond purchases, but let's look at real yields. And we know Madame Lagarde said they looked at a plethora of financial conditions indicator. Real yields are now the lowest they've ever been. They're at negative 1.2%, and they continue to fall, right? Partially because of the rise in inflation expectations. So again, overanalyzing the pace of bond purchases when the actual broad measures of financial conditions are giving the ECB a lot of leeway, it's probably not a good use of time. I think Steve is absolutely right. The recovery fund deployment has been delayed. So that's the major problem. There is no action in the economy. The narrative has to switch on that front. We need to see a better vaccine rollout, and we need to see the deployment of the recovery fund to really take place, because the real question, we're focusing on the recovery fund, but the real question will be, when the pandemic is over, we need to talk about real stimulus. This recovery fund is only doing income replenishment. It's trying to offset the income that we have already lost. We need to look beyond that.
Couple of points there. So let's start with the first one about the communication out of the ECB. If they had not emphasized front loading and just